So much for taking the time out to be with us today. I'm Brinda Iyer, and it is my pleasure to welcome you to Nykaa's first Investor and Analyst Day 2022. These sessions today present us with an opportunity to connect with a much wider community of investors and analysts from around the world. Present for today's event are the following members from Nykaa: Falguni Nair, Executive Chairperson, Managing Director and Chief Executive Officer; Advaita Nair, Co-founder Nykaa and Chief Executive Officer Nykaa Fashion; Anchit Nair, Chief Executive Officer Beauty E-commerce; Vikas Gupta, Chief Executive Officer Nykaa Distribution and Nykaa International; Arvind Agarwal, Chief Financial Officer. Today's session will be broadly conducted in two parts. In the first half of the discussion, from 4 p.m. to 6 p.m., our management team will take you through our various business verticals and focus areas. Following that, we will open the session for questions. During these sessions, please feel free to leave your questions in the comments and we will address them during the Q&A. With that, I now introduce our first speaker, Anchit Nair, CEO E-commerce. With his deep understanding of the retail and beauty business, Anchit has played a pivotal role in making Nykaa India's leading multi-brand retailer. He crafted Nykaa's multi-pronged strategy of exclusive partnerships with the best global brands in beauty, our own brands, and an offline presence, which has given Nykaa its sharp competitive edge. Over to you, Anchit.
Yeah, great. Thank you very much, Brinda, and thank you to all the investors and analysts who dialed in for this virtual investor day. So first, I hope I'm audible. Brinda, can you confirm?
Yes, all good.
Okay, great. So I'll kick it off with the beauty business first. So just to recap, beginning obviously with the total addressable market for the beauty and personal care segment in India today, we see it as around about a roughly $16 billion market in US dollar terms, and 70% plus of that is unorganized, with the remainder being split between organized and online. So today, online penetration of the BPC segment is roughly 8%, so single digit, well below averages in other developing markets. Leave aside the developed markets. However, we are incredibly optimistic that the growth of the BPC segment in India is going to be strong in the coming years. We forecast around a 12% CAGR for the overall BPC segment. Within that, online is said to be the fastest growing sub-segment within BPC, with a CAGR of roughly 35 to 40%, leading it to account for almost 20 to 25% of the total BPC market by 2025. Now, Nykaa is a retailer who plays in all three parts of the BPC market. Clearly, Nykaa.com is a leader within the online segment. Our Nykaa Luxe, Nykaa On Trend, and Nykaa Kiosk store formats are leaders in specialty beauty retail in the offline organized segment. And our latest new business initiative, the Nykaa Superstore, is an B2B platform that now caters to the largest part of the market, which is the unorganized offline BPC segment. And we will touch upon that B2B business later in the deck. Next slide, please. Now, coming to the favorable tailwinds that are driving the accelerated growth for BPC in India today, it's really, when we think about it, it comes down to 6 major factors. And I'll start from the top left and work clockwise. So the first has been the growth in spend by millennial and Generation Z customers when it comes to beauty. And there has been a large increase in the spend on discretionary categories, of which BPC has been an outlier in terms of the increase in the spend. Now, if I look at the second key driver, the second favorable tailwind, that is the rise of spend in beauty-specific categories. Beauty categories such as cosmetics, premium skincare, and fragrances are categories that are growing faster than the legacy personal care categories. So beauty and personal care consists of both personal care categories such as oral care, hair care, and some others. But Nykaa is a leader on the beauty side of BPC, and those are the categories that are growing faster than the average 12% CAGR that I showed in the previous slide. The third favorable tailwind has been the premiumization trend that we've seen. There is clearly a premiumization trend within our consumer base. And we see that as there is an increase in awareness, aspiration, and the ability to spend, Nykaa consumers tend to upgrade their baskets and the brands and the average selling price of the product which they are purchasing. Now, when I look at the fourth key driver, it has been the explosion of online content-led discovery. We believe that social commerce and live selling, amongst others, have played the role of democratizing the access to information that earlier was restricted due to the availability of online content platforms such as ours. Fifth is personalization. There has been a rise in hyper-personalization and bespoke solutions that are tailored depending on the consumer need. We have managed to leverage technology to allow us to show the most relevant brands to the relevant consumers, thereby increasing the ability for the consumer to find what is most relevant to them and therefore driving conversion. Finally, I come to digital integration. There has been an increase in the use of digital tools such as virtual try-ons and virtual stores. And Nykaa has been a pioneer in this front. We have launched a virtual try-on tool on our app that is called ModiFace. It is a tool that has been brought to India by the L'Oreal Group, and it is something we have integrated into our app online. And the purpose behind these tools is to help Nykaa to replicate what has historically and traditionally been a very unique experience reserved mostly for physical retail stores. We now have the ability to recreate those experiences online. Next slide, please. So as many of you know, today Nykaa is one of India's largest specialty beauty and personal care platforms. Just quickly running through some high-level numbers, I'll start on the top right of the slide. As of FY22, Nykaa Beauty's GMV was roughly 5,000 crores, which was a 49% growth year over year. So strong growth despite a couple of waves of the COVID pandemic. Second, our annual unique transacting customer base now tallies at 8.4 million. And this again represents a very healthy growth of almost 50% year over year. If I look at the number of new customers that Nykaa.com acquired, it was 4.4 million for FY22. So a very substantial number off of an already significant base. And finally, if I look at the improvement in the mix between existing and new buyers, in FY 2019, 55% of our GMV came from what we refer to as existing or repeat buyers. That number has increased by almost 20 percentage points to close to 73% of our business coming from existing buyers in FY22. So a testament to the kind of loyalty and retention that Nykaa has been able to drive amongst its consumer base. Now, coming to the screenshot images on the left-hand side of the page, today Nykaa has over 47 million app downloads for Nykaa.com, the beauty app. Again, a very strong 44% growth year over year, demonstrating our ability to continue to acquire new customers and to drive awareness for the Nykaa platform. There was 20.8 million monthly average unique visitors to our app or our mobile web for the year FY22. And this was an almost 54% growth year over year. Finally, Nykaa.com managed to service 27 million orders that were placed by our consumers on our platform in FY22. Next slide, please. So we are strong believers in innovation, and we believe that there has been very strong category growth that has been driven by this focus on constant innovation in curation and assortment. So today we partner with almost 3,000 brand partners in the beauty and personal care space. These include some of the most well-known global brands, but they also include a lot of homegrown, domestic, direct-to-consumer brands across multiple categories. If I look at the GMV category mix for the BPC business on Nykaa, today makeup and skin are roughly our largest categories. They account for roughly a third of our total business each. And they are both growing at a very healthy growth rate year over year. So makeup grew at roughly 40% plus in FY22 on a year over year basis, already off of a very large base. If I look at skincare, that segment grew at roughly 50%, so a full 10 percentage points faster than makeup. And I think that's a global trend you're seeing, where skincare has outpaced makeup growth globally. And we're seeing similar trends on Nykaa.com as well. If I look at hair care is a business that has, again, grown very rapidly, around 60% growth year over year for us, and today accounts for roughly 15% of our total revenue mix category-wise. Finally, we've got other categories. These include categories such as personal care, fragrances, mom and baby, health and wellness, and appliances. And these categories today are growing almost at around 80 to 100% year over year. So yes, relatively a smaller base for these categories, but very strong growth as well. Now, if I look at curation, we believe that curation plays a very important role in helping the consumer to make the right choice for themselves. And at Nykaa, we look to lead the way in the way that we curate our assortment. And here on the screen is just a couple of examples of some of the recent curations that we've done. The one on the left is the Conscious at Nykaa curation. So Nykaa is a strong believer in driving the adoption of what we refer to as conscious beauty brands. These are brands that are either vegan in terms of the ingredients that are used, they're cruelty-free brands, or they're clean brands. And we believe that this is a trend that is obviously good for the environment, it's good for the customer, and it is something we are looking to build awareness for in the Indian context. Next slide, please. Coming to, so I think until now, the deck has mostly focused on, our role as a multi-brand retailer. So just taking a slight step away from that and discussing a little bit about our owned, what we refer to as our owned consumer brands. So what Nykaa does is that we identify and try to address certain gaps that we see in the market through a collection of very innovative, new age owned brands. If I refer to the brands that are listed on this page, first and foremost is Nykaa Cosmetics, which is our color cosmetics brand, also our oldest brand within the portfolio. Second, we've got Nykaa Naturals, which is as the name suggests, a natural, clean skincare brand. And then we've got K-Beauty, which is a joint, which is in partnership with Katrina Kaif. That is India's first celebrity-led beauty brand, again, focused heavily on cosmetics, slightly more premium in terms of selling price and positioning to Nykaa Cosmetics. And this brand has, again, seen very good traction with the consumers. Fourth is our launch of derma-based skincare. I think Nykaa realized that derma cosmetics was going to be a big trend in India as well. We've seen that trend globally. As a result, we identified it as an opportunity for us, and we've launched Nykaa Skin RX, which is our serums and moisturizers brand that is based on active ingredients. Fifth is our Korean beauty brand, Nykaa Skin Secrets. This is a collection of products that are based on Korean rituals of beauty, such as sheet masks and certain other SKUs. Again, we had identified the trend of Korean beauty roughly 2.5 years ago. And we noticed that no one was doing it in a way that was really relevant to the Indian consumer. And so using our knowledge, we made Korean beauty relevant and recognizable to the Indian consumer by adding certain Indian ingredients to our products. And this brand is known as Skin Secrets. Today, roughly 3.1 million customers transact annually with our own brands in FY22. Just as part of the previous slide, just a continuation, we also have a bath and body brand that is called Wanderlust. We have a fragrance brand that is known as Moi by Nykaa. We have also made certain acquisitions to further bolster our capabilities and also to increase the assortment and the different positionings that we would like to be present in within beauty. Those three acquisitions include Dot & Key, which was an acquisition of a premium skincare brand. Again, it's a brand that is a domestic brand started by some very bright young entrepreneurs in India. And we were very interested and impressed by the work that they were doing. And we thought it would complement our suite of offerings. And therefore, we decided to make that investment in that acquisition. Second is Earth Rhythm. Earth Rhythm is a more recent acquisition that, again, has been something we've spoken about in the past. It was a brand which we identified as being very in tune with what the consumers were looking for with regards to sustainability, both in the skincare and the personal care space. And so this is a brand in which we have made an investment to help them to foster their growth and to also give them access to all of the capabilities that Nykaa has to allow them to scale their business and remain, on the leading in the leading forefront of innovation when it comes to sustainability in the skincare space. Finally, there is the Nudge brand. It is a nutraceutical beauty brand. We at Nykaa are strong believers that wellness is in many ways the flip side of the beauty coin. And so we realized that this is a need. There is the penetration of wellness brands in the market is relatively low. And we think this is something our consumers would appreciate. And as a result, we have made an investment in the parent company, which has allowed us to kick this brand off the ground. And it is known as Nudge Superfoods. And today, close to 11.2% of the total GMV for our beauty and personal care business comes from our own brands. Coming to a different business, which we've not touched upon in too much detail historically, so I thought this could be a good opportunity for us to discuss, is the Nykaa Imports business. So today, Nykaa imports and distributes some of the most well-renowned and trending brands that are available globally. The way we do it is Nykaa serves as a one-stop shop for the brand in India. So we are able to import the brand, distribute the brand, and also serve as a retailer, finally to the end consumer. So what are the different capabilities which we offer to these partners? One is we help them to decide their entry into the India market strategy. We handle their registration and import logistics. We also handle the warehousing. And finally, we serve as their brand custodians in the country. What this means is that we tend to operate like a brand satellite office on behalf of these import brands. They have no requirement to set up a physical office or to hire employees in India. We will handle pretty much A to Z for them, which includes pricing, distribution, go-to-market, as well as customer service. And this is a very formidable offering to a lot of trending brands globally that may not have the capabilities, the bandwidth, or the infrastructure to come to India on their own. As a result, this portfolio has grown meaningfully in the past couple of years. Today, we have 22 brands which we import and distribute within the country. And this portfolio of brands are growing at roughly 70% year over year for FY22. So almost 20 percentage points faster than the overall platform. Just to give you a sense of what are some of these brands that we currently import. So the list is obviously up on the screen, but just to call out some of the best known brands, of course, would be Charlotte Tilbury, which is the leading, if not the number one, color cosmetics brand in the UK. Huda Beauty, another fantastic brand out of the Middle East. Elf Cosmetics, Morphe, Rimmel London, and Sally Hansen, which are from the Coty portfolio, and some others as well. On the left is just a screen grab that shows just the kind of technology that we've built to allow the discoverability of these import brands. So it is a separate shop-in-shop within the app that is known as the Nykaa Global Store. And all of these brands can be discovered and shopped directly from that part of the app. So finally, what is the proposition that has attracted so many brands to join the Nykaa Imports portfolio? And it is at the bottom of the screen, you'll see that it's a very unique ability that Nykaa offers the brand, an ability to target close to 15 million beauty enthusiasts from day one. So the minute that we launch the brand in India and we list them on our app, we give them visibility on the app as well as on the .com, on the website. And we also roll them out across our physical retail stores. They have access to 15 million customers and beauty enthusiasts on day one itself. So that kind of visibility is large. It's quite a meaningful scale, and as a result, we're able to drive awareness and scale for these brands in a very accelerated fashion. Now, pivoting to our role as a digital influencer in the beauty space. So today, we believe that Nykaa is one of the most loved and largest beauty retail platforms in the country. I think that's clearly reflected also in the fact that we've got almost 13 million plus social media followers across various channels, including Instagram, YouTube, and Facebook. And we have close to, I think, 6 to 8 of our own social media handles across beauty and fashion to cater to this very large base of followers on social media. Secondly, we work with close to 5,400 plus influencers across all tiers of cities and influencers of all sizes. If I look at if I talk a little bit about our watch and buy feature, so we have the ability to show content on the app itself. We call it watch and buy, which means that all of the short form content that we create is watchable and totally shoppable from within the app itself. And we launched this feature, I think, roughly 6 to 8 months ago. So very recent launch, but it was some tech innovation that we built in-house. And today, this Explore Watch and Buy feature gets close to 23 million post views in FY22. On the left-hand side of the page, we have just some screen grabs of some of the TV campaigns which we ran this year. I think for us, we've realized that we are market leaders, we are thought leaders in beauty, and we need to take a meaningful stance on the subjects that matter for our consumers. So we've launched some brand campaigns on TV that we do not have the clips for here, but I encourage you to take a look offline. These TV commercials and campaigns, as well as some digital-only campaigns we've done across digital channels, has allowed us to improve our top-of-mind awareness by close to 5 points, according to Kantar research. And this is a lead of almost 12 points over the nearest e-commerce platform competitor of ours. There's also been a market improvement in the most used brand by almost 8 points. Again, this is Kantar research. And a lead of almost 10 points over our nearest competitor on the e-commerce side. So just a couple more examples of the kind of content that we create. We've always said Nykaa is a content-first retailer. We leverage content very effectively to drive engagement, to drive aspiration, and finally to drive individuality. And we believe that content finally is the enabler that allows us to grow the market and to expand the consumption of beauty in the country. And these are just a couple of examples of some of the kind of very on-trend and specialized content that we are able to create, because as a vertically specialized retailer, we like to think that we are experts in this category. Next, please. So I touched upon watch and buy briefly. So just a video to show you how.
Nykaa's biggest beauty steal. I'm seeing all your comments. Yes, absolutely. Someone's written, this is my favorite blush. Yes, I think it has a flat 50% off. Anything on your screen, guys, I'm going to catch up.
Yeah, so I think it was, again, I encourage you all to, open your Nykaa app. And if you don't have it, of course, so please download it and really explore the watch and buy feature for yourself. It is an incredible development that we've done. It is, I think the inspiration for us came from what we were seeing in China. At Nykaa, we always say that we draw inspiration not only from the beauty retailers in the West, but even more so from those who are doing very interesting things in Southeast Asia and other markets. And we realized that live streaming and video selling is something that could really add value to our consumers. So we built the technology in-house, and we've seen strong traction on that front as well. And of course, for our brand partners, it's a fantastic way for them to be able to engage with our consumers and to tell their brand story. Now, moving from content and marketing to physical retail, today Nykaa is committed to growing our physical footprint efficiently in order to cater to the consumer demand that we're seeing offline. I think if you remember the first slide I showed in terms of the addressable market, physical retail remains almost 90% plus of the total BPC market. And yes, that is set to decrease, and online is set to take market share going forward. But even within the next 5 years, physical retail will account for a majority of BPC sales in the country. As a result, Nykaa has committed itself to expanding its footprint. And today, as you can see on the slide, we are sitting at over 105 retail stores as of the end of March fiscal year end 2022. If you look at the beginning of the slide, at the beginning of the chart, you can see that as of FY 2019, we sat at roughly 34 stores, and we delivered a GMV of about 72 crores. That number has grown around at a CAGR of the CAGR is not on the slide, but as you can see, it's grown roughly about 140% year over year in FY 20 to about 173 crores of GMV. FY 21, as everyone knows, was of course a COVID affected year. So we slowed the growth of our retail footprint. And as you can see, we only opened 6 new stores in that year, but we still showed positive growth of about 11% in terms of GMV. And finally, FY 22, which despite having had some impact of COVID, has managed to grow at 72% year over year, taking the size of our retail business to roughly 330 CR across the 105 stores that we have open in the country. So today, physical retail contributes around 6.5% to 7% of our total GMV. As of Q4 FY22, that number sat at around 7.5%. So back to pre-COVID levels, if not higher. And I always say though that this is a very healthy share. And if we think about some of the brands, some of the premium brands which sit in both our physical stores as well as online, for them, the online versus offline split of revenue is very different. It can be up to 30 to 40% of their sales comes from physical retail. However, this is obviously online. We retail over 3,000 brands, and we ship across the country. So it's not really apples to apples, but it still gives you an indicative sense of the strong growth that we're seeing in the retail business. Now, if I look at, I use the word efficiently in the title of the slide because you can see that reflected in our CapEx spend by year. In FY22, we spent roughly 18.5 crores on CapEx. That was to open roughly, you can see almost 32 stores. And that's taken our footprint to around 49 cities. So we now have stores across tier 1, 2, and 3 metros and cities in the country. Now, our stores are not just there for brand building. They're there to add to obviously serve our consumers, but to also add to the bottom line. And what we're seeing is that as of FY22, year-end FY22, 80% of our 105 stores were EBITDA positive. And if I look at just Q3 FY22, because that is a year that was, we could say by and large, that was a quarter that was by and large untouched by the COVID pandemic, almost 90% of our stores were EBITDA positive. Our stores do roughly 3,500 rupees of GMV per square foot. And our stores cover roughly 100,000 square feet of retail space across the 49 cities in which we are present. These are just some images of our stores. You can see we've got two formats, majorly the Nykaa Luxe format and the Nykaa Trend format. The Nykaa Luxe format, as you can see in top left, is a very premium, luxurious experience and execution. We have some of the most luxurious brands globally, whether it be the Dior's, the Jo Malone's, the Estée Lauders of the world. So it's really a collection of the prestige brands, both global and domestic. These stores tend to be slightly on the larger side on average. They are roughly about 1,100 to 1,200 square feet in size. However, we do have some of our more recent luxury stores that are even larger in size in terms of floor plate. On trend, Nykaa on trend, the imagery on the bottom left, those are stores for slightly a younger audience, slightly more fun. As you can see, it's a collection of what we refer to as brands that are trending on the platform, that are seeing a lot of consumer love. And these brands tend to span from masstige to prestige. On average, these stores tend to be slightly smaller, roughly 950 square feet in size. So still large enough to keep the right assortment of brands, but slightly smaller than our luxury stores. If I look at some other interesting statistics about our business, today we have almost 480 what we refer to as beauty advisors who serve our consumers in our stores. They are very well trained by our in-house learning and development teams to ensure that they're able to provide a very personalized selling experience and a very knowledgeable selling experience to the consumers in our stores. Second, Nykaa Physical Retail has developed the hyperlocal delivery capability. What this means is that we are able to service online orders from our offline physical retail stores. So it has given us truly a hub and spoke distribution and fulfillment model that has allowed us to deliver to our consumers faster, and also for us to manage inventory constraints and excess inventory problems if and when they arise in physical retail stores very efficiently. Finally, we also have the ability to offer endless aisles. So if there is a certain SKU that is unavailable for purchase in the store, that product can be ordered in the store via devices, tablets, and be delivered to your home online seamlessly. Finally, being an omnichannel retailer, we're also able to drive footfalls and drive our consumers into our physical retail stores via the app, via app pushes or emailers or other methods of communication with our consumers. Today, if I look at the location of our stores, we have roughly 75 of our stores are present in what we refer to as malls, grade A malls usually. And about 30 of our stores are present on high streets. 50% of the stores which we've opened are present in what we refer to as tier 2, tier 3 cities. These include the likes of Agra, Allahabad, Gwalior, Kozhikode, Nashik, Rajkot, and Vizag. And for FY22, all the stores that we launched, roughly those 32 stores that we launched, the average size of those stores was about 1,000 square feet in size. Next slide, please. Now, coming to something that I think is a testament to the deep relationships that we have with our brand partners, and that is the launch of what is called the Avida X Nykaa salons. So Estee Lauder, a group of companies, chose to partner with Nykaa in India to launch their premium salon offering that is known as Avida Salons globally. And in India, it's known as the Avida X Nykaa Lifestyle Salons. Avida has close to 9,000 plus salons globally across 40 different countries. Avida is a brand that is owned by the Estee Lauder group of companies and is a global leader in natural luxury hair products and services. The Avida X Nykaa salons are a one-stop lifestyle salon destination for both men and women. We provide 100% vegan premium hair services and a selection of the best-selling products from both Avida as well as Nykaa's assortment of brands. Our first co-branded salon opened in Bangalore in April of 2022, and there are plans to open more this year. This is just an image of our fulfillment center as we get into the part of our presentation about our fulfillment capabilities. So Nykaa has been on a journey over the past 12 months to transition itself from a national to a regional fulfillment model. And this is being done solely to better serve our consumers. Today, we serve close to 28,000 PIN codes, and that has improved our serviceability from 86% in FY21 to close to 98% in FY22. As you can see from the map of India on the left, we now have warehouses pretty much in all four corners of the country. So these 23 warehouses that we today have are spread evenly across all parts of the nation. We had 18 warehouses going into coming out of FY21 and coming out of FY22, that number has gone to 23. the capacity that we have has expanded from 5.8 lakh square feet to 8.2 lakh square feet, representing a growth of roughly 40%. And today we have warehouses in across 11 cities. If I look at what has been the impact on this continuous process of increasing our warehouse footprint and also distributing them regionally versus clustering them in major metros, the result has been that our average order to delivery timeline has improved substantially. In 2013, as a young business, on average, our orders were taking roughly 7 days to deliver. So from order to delivery was roughly 7 days. That came down in 2016 to 5 days, in 2019 to 3.5 days. And today in 2022, the average order to delivery timeline is about 2.8 days. And if I look at just Q4 22 numbers, that was down to 2.4 days, which clearly enables a better consumer experience. Now, again, this is an average. So this includes all of the PIN codes which we service, which are sometimes hard to reach. Of course, in major metros, as well as in tier 1 and tier 2 cities, our delivery times can be and are better than even this average. So this regional, the investment that we made in expanding our warehouse capacity, it has not only improved the consumer experience as I described on the previous slide, but it has also had it has driven meaningful efficiency for us in our fulfillment cost as well. If I look at our split shipment ratio, which is a measure of the number of packages that a consumer receives per one order, the split shipment ratio has consistently declined quarter over quarter sequentially to where it is today. If I look at the air shipment share, air shipments usually are a result of the warehouse and the fulfillment centers being at a great distance from the consumer, and air shipment does tend to be more expensive than road shipment. And we've seen that even the split of air shipment versus road has come down substantially quarter on quarter, and you can see where it lies today in Q4. Finally, both of these factors have allowed us to bring down our fulfillment expense as a percent of consolidated revenue from roughly 11.4% in quarter 1 of FY22 to 9.7% in quarter 4 of FY22. Sorry, just go back one slide. Yeah, and on the right-hand side, you can just see that on an annual basis. So clearly, we have seen that the investment we made in regionalizing our fulfillment capacity has had meaningful impact and driven meaningful efficiency when it comes to our fulfillment cost as well. Next slide, please. So with that, that's the end of the beauty and personal care section. We'd be happy to answer all the questions that are being left in the comment box at the end of the presentation. But with that, I would like to hand it over to Adwaita to take you through the fashion section. Thank you very much.
Hi, everyone. It's a pleasure to talk to you about the fashion business today. So, a couple of years ago, about 3.5 years ago, we thought about foraying into fashion. We felt that it would be a great new frontier for Nykaa to take on. A large part of that reasoning was what we see here on this slide, which is just the sheer market size and the opportunity that fashion presents. So here you can see that in 2020, fashion is a $54 billion industry, projected to grow to $124 billion over the next 5 years. By 2025. And you can see the split within that between online at 20 to 27%, and then organized and unorganized at broadly 35 to 40% each. So, just the sheer size and opportunity is really what, tempted us into this market. I always say that for us, even though we are a late entrant in fashion, if we're able to get even 10% of the online share by 2025, that's a very, very sizable business in the scheme of Nykaa. Can move on. So as we were entering and, we thought long and hard about how do we create the right level of differentiation. So we did spend a lot of time trying to understand what were the gaps in the market. We heard things that, that the existing platforms out there were very discount driven, where there was limited focus on trends and new season styles. We heard from customers, we did extensive customer surveys, and we heard from customers that they felt overwhelmed with the excessive number of SKUs that they had to sort through to find the right pieces for themselves on competition platforms. We heard from brands that on these existing platforms, they didn't have the ability to tell their brand story, to really sell what they wanted to sell their new launches. So brands were also frustrated in some ways. And we also noticed that there were no real omni-channel players out there that were truly doing offline and online, both in a multi-brand format. So basis both the market size and opportunity, as well as the gaps that we noticed, we started to craft what our mission, vision, what our differentiation could be. And that brings me to my next slide, which is really our vision. So just pausing on our vision and reading this out, it's to inspire Indian women and men to make the right fashion and lifestyle choices that best suit them. My intent is really to build something that is very differentiated to the competition that exists out there. And we're trying to do it on the back of three main pillars. So the first is really around assortment. I do feel that all e-commerce and fashion in particular is about nailing assortment. I think what strikes me is just how different beauty and fashion are from an assortment perspective. Fashion is far more long tail. There are a huge number of SKUs out there, and really the platform has to have a point of view. My philosophy when it comes to merchandising is that there needs to be completeness in terms of assortment. So everything you could possibly be looking for, whether it's something warm for winter, whether it's something that you need for your friend's wedding, whether it's accessories of a particular type, every type of completeness of assortment has to be delivered. But within that, I want to be extremely curated in depth. And that's really one of the differentiation. How much curation can we bring to the merchandise that we put out there? So a huge emphasis on our platform is bringing the right set of brands, and within the right set of brands, the right set of product to the customer. And so this is not something that we're blindly just onboarding. We're just trying to be very thoughtful about the type of assortment we bring to the table. The second pillar is acquiring the strong and the right type of customer base. I already mentioned that I'm very clear that we want to get a specific type of customer base that demonstrates the right behavior. It's a customer base that is fashion forward, that appreciates design, trend, and is looking for something more aspirational than what exists in the market today. So really finding that right type of customer and adding value to them is what we're going for. And then the third pillar, of course, and that is the Nykaa DNA, is to build content and customer journeys that aid discovery. And that's really the word inspiration, which you see in the vision as well. Fashion is all about inspiration. How do you get the customer to really understand what's the right product for them, how to style the right product? And the way we weave content and inspiration through the journey is obviously through things like video and blogs, of course, but also through very unique product level features, whether it's recommendation widgets, whether it's style it with widgets. There's a lot of product level features that we try to develop to really take people and customers down this fashion rabbit hole, as we like to say. How do you make it as enjoyable as possible for them to keep discovering more and more? So that's been the mission, that's been the vision, and that's how we're trying to differentiate. Moving on. I'll now touch upon each of the three pillars that I sort of mentioned. So first, we'll start with assortment. The last two and a half years have been very, very focused on rapid brand onboarding and assortment. So on the left-hand side, you'll just see the sheer amount of brand onboarding that has happened. So you can really say that fashion is pretty much a two and a half year journey so far. From 415 brands in FY20 to over 1,500 brands in FY 2022. We've been very focused on making sure that we just have the sheer amount of breadth and width to be able to service the Indian consumer. The green line shows the number of SKUs we have, and this is really what I was talking about when I said that fashion is such a high proliferation business. You'll see that today fashion has 4.3 million SKUs, up from 50,000 just 2 years ago. The sheer SKU proliferation means that fashion is the ultimate discovery problem, and therefore there's a lot of value we can add by really guiding the customer to the right product. On the right-hand side of that first chart, you'll see another view that we're presenting for the first time, which basically shows how over the last 2 years, we've also expanded beyond just women, and we've added men, kids, and home, and other categories, and these are actually becoming pretty meaningful for us. Also very interesting, which we've not shared on the slide, is the shift within the division. So within women's wear, seeing a lot of very interesting behavior trending towards very strong Indian wear and Western wear consumption in terms of apparel. And a lot of those trends are actually driving the increase in AOV that you will also notice in other parts of the deck, and I'm sure you've picked up on. Moving on. Still talking about assortment, I really want to spend some time talking about this differentiated assortment. Often when I speak to some of you, I get a lot of questions about really, but how is it differentiated? And I've put two sort of representative, so these are just representative, they're not actual numbers or actual share of business charts that I believe will help you understand our assortment strategy. So on the left-hand side, you can see how in these colored buckets, I'm trying to show you that we're onboarding all types of brands. So you've got your national brands, which are like your B-Bars and Ws. We've got international brands like your Adidas, Reebok, Forever New. We've got the blue category, which we call the hidden gems, which is a big value peg for us, which is really, these interesting emerging niche brands from across the country. This is really something customers are starting to love us for. It's very differentiated, it's something hard to find on other platforms. The yellow brands are what we call global and import brands. Anchit spoke about it. Import has been a big strategy in beauty, and it will also be a big strategy in fashion. There are a couple of import brands that have already launched on the platform, and a lot more that you'll see over the next couple of months. Then D2C brands, luxury brands, and responsible, i.e. sustainable brands. And for me, making sure that this mix comes together is absolutely critical. I don't want us to be just a niche business. We also need to have the national and international brands. That's the back on which we'll build scalable business. But at the same time, it's this mix of business that makes it very interesting for the customer. So making sure we're growing each of these is quite critical. On the right-hand side, I talk about how, we want to touch upon all price points. I think that is the Nykaa philosophy. So we will have mass, masstige, premium, and luxe. And we do, do business across all. I would say masstige and premium is really where our focus is. But I definitely don't want, people to take away the impression that this platform does not have more affordable products, because they are there. And so when I do say that we want to build differentiation and premiumization, it's not that we won't list the products that are more accessible. It's just the way we will sell them is that we're trying to shift the conversation away from discount and make it more about fashion and style and trend. Moving on. The next couple of slides just show you a glimpse of the product, which is very differentiated, and hopefully, tempts you to download the Nykaa Fashion app separately and shop as well. So we can just flip through a couple of these slides. So moving on away from assortment, I talk about the next thing. Over the last year, we've also focused a lot on marketing. And that's something you're probably able to read through the P&L and wonder, what were some of the marketing changes we made last year. It was the first year we actually did TV for Nykaa Fashion. It's the first year where we actually also took on a brand ambassador, Alaya F. So it was the first year of mass media spend. And the focus for me is, constantly adding to all parts of the funnel, both top of mind, top of the funnel, but also middle and bottom. On the right-hand side, you can see some other activations that again had, wider reach. Moving on. This slide just shows the other elements that we've kind of addressed within building the brand. So working with over 1,000 influencers. We've launched something called Style Advice, where you can actually chat with our style advisors. That's been picked up quite well by the customer. Like Anchit showed, we also have a, watch and buy live fashion, live commerce tool that we've been using well. We have videos that we call Styling 101. So, the point here simply is that as in beauty, where content played a big role, fashion also needs content. And we're also creating the relevant and the right properties for fashion to make sure that we're inspiring the customer. Moving on, away from pure content and brand building, I wanted to touch upon a couple of very interesting product level features we're building. So, I think something I'm really passionate about is seeing the differences between beauty and fashion. And I do feel that the way people and women shop for beauty and fashion are actually incredibly different. And the differences actually mean you should be building very unique product and user experiences on the app. And that is actually why we built these as separate apps. It started as sort of a, idea and a gut feeling, but over time we've come to really believe that building separate apps was the absolute right decision, because really we find that the way people interact, whether it's how they interact with the homepage, whether it's how they interact with the search bar, the recommendation widgets, the number of times they visit before they convert, their repeat behavior, it's so wildly different on beauty and fashion that actually we've been able to build very unique product experiences separately, and we continue, and all of this has really furthered and sort of strengthened our belief that we really believe in vertical commerce. So on this slide, I kind of point out a couple of things. For example, on the right-hand side, you'll see that we've designed these hybrid pages, the utmost right image, where you see that, for even a brand like Puma, we try to go into complete level of depth, really educating and teaching the customer how to find the right product for themselves. Move on. Here, I think we again give you a glimpse of the types of things we're doing on product. So, very in-depth information on everything from sneakers, curating very interesting curations for the plus size woman, which is the next image. The third image is what you see, what I mentioned as hidden gems, really educating the customer on what these labels are and where you can find them. And then finally, sustainable and responsible. And these are the curations that I really think make us stand out. And you don't see a lot of players doing things like these. Moving on. I think on this slide, two pretty interesting features. The middle one, this is, for example, something we built in-house. The middle one, where we talk about explore similar items. This is something that we built in-house, basis visual recommendations, where just basis what you're looking at, we're constantly encouraging you to find products that also look like that. This ends up driving more than 30% of our revenue. This is, again, something that's very different than the behavior we see on beauty. And the utmost right-hand side is some new innovation we're trying in personalization. So basis what you've seen, a completely personalized feed that we'll be rolling out shortly. Can move on. Moving on, away from assortment, product, content, brand building, one of the final things I want to talk about is how over the last year, we've really invested in fashion to be able to support multiple different operating models. Today, fashion can support inventory-led, of course. That's where we started with the beauty business, but we've also built complete technology to support marketplace. That's something we've been really heads down working on for the last 2 years. And today we have world-class marketplace technology, whether it's listing from multiple warehouses, whether it's listing and integrating with our brand stores. And then finally, we also support something called B2B2C, which is a model that we typically use even for our global partners. So all in all, when you look at this slide, what I want to communicate is really that the business is able to support many different operating models in a very flexible way. And again, that's very important for fashion, where it's much harder to predict what's going to sell. So as you know, our beauty business is predominantly inventory, but in inventory based, but in fashion, because it's so much harder to predict what will sell, we are predominantly marketplace, but we do use inventory selectively here and there, and that will also accelerate further. But being able to be and conduct marketplace was absolutely essential to build the business correctly and not take unnecessary risk on the inventory side. So on the basis of all sort of the slides I've just spoken about, what we've been working on, what we've been focusing on, our positioning, I think we've had a really good 2.5 years. These 3 slides demonstrate that. On the left-hand side, we can talk about GMV, up from 186 crores in FY20 to 1,750 in FY22. The business has grown incredibly well with a CAGR of over 200%, and this past year at 168%. On the bottom of the same chart, you can see what percentage of the overall Nykaa business fashion contributed to. So up from 7% in FY20 to 25% in this past year. I would also, like to highlight when we're talking about this first graph that the business has been contribution margin positive in FY22. Next, moving on to the next chart, you can see how the new customers have also accelerated from 600,000 in FY21 to 1.6 million in FY22. And similarly, orders have also grown, from 2.4 million to 5.2 million in FY22. 3 metrics, some of these we're sort of revealing for the first time. So average order value we have spoken about before, but it is at 3,420, far higher than what the industry sees. But other metrics that I personally like to track to make sure that we're staying true to our mission and vision is the percentage of sales that happens on new season stock, which in fashion is really the trendiest stock, and it's really the stock that's very differentiated, is 29%. Again, from what we hear from our brand partners who sell on other platforms, they're not able to see this kind of sale on their new season merchandise with other platforms. And then lastly, what percentage of sales is coming at full price? And for us, that's about 15%. So I like to think of our business in 2 parts. So we have the platform side, which I've just covered, which is the nykaafashion.com, the app where we sell over 1,500 brands. The other side of our business is what we call owned brands, i.e. private labels, but we like to call them owned brands because these are brands that we truly want them to stand on their own feet and have lives of their own. So over the last 2.5, 3 years, we've been building brands from 1 brand in FY20 to 6 brands in FY22. the percentage of the platform sale, or the percentage of the consolidated fashion turnover that's coming from these own brands is now 7.8%, and it's growing very fast, faster than the platform, in fact. And for me, the reason I'm starting these own brands is really twofold. The first is wherever we see very glaring gaps in assortment, we think it's important to start an own brand because it helps us bolster our assortment and our differentiation. But also some of these brands are brands and categories where I think India overall has a gap. And so some of these brands, I actually think there's an opportunity for us to create some form of market leadership in the category overall and not just on our platform. Can move on. This gives you a glimpse. The top chart just shows you which years we've been launching. So as you can see, the acceleration has been increasing in terms of new brands that are being launched. And more importantly, the bottom chart shows you the brands that we have by category. So we have been sort of systematically trying to cover all categories, starting with women's, lingerie, athleisure, and so forth, but even now entering home, men, and so forth. So again, I think here as well, I'm trying to go for completeness in terms of the categories that we're able to cover. Moving on. This just gives you a glimpse of some of our brands, from Western wear to lingerie to Indian wear. Moving on. To athleisure, to footwear, bags. In own brands, I think it's particularly important to build brand, and therefore we've been tying up with designer celebrities as well as Masaba and Nikhil Thampi, etc. So this has been something we're trying to do that's a bit differentiated. Can move on. This just gives you a glimpse of the clothing. So with this slide, what we're trying to say is that, like I said, each brand will have its own strategy. But for some of these brands, we will list far beyond just Nykaa Fashion as a platform. So for example, Naked, which is our lingerie brand, we're planning on opening physical stores for the brand as early as next month. And I do think Naked, the lingerie brand, has the potential to truly be a large lingerie player in the country and stand on its own 2 feet. A lot of our brands sell on other platforms, whether it's Myntra, Ajio, Amazon. Some of our brands even sell in multi-brand outlets, whether it's 20 Dresses or Naked. And for all our brands, we will have D2C websites. So that's something that we've been rolling out as well. We can move on. This gives you a glimpse of the D2C websites that we're creating for our own brands. So right now, bulk of the transactions happen on Nykaa Fashion, but we do believe that by actually letting these be brands and not private labels, there's a lot of potential here. Can move on. This gives you a glimpse of some of the physical stores that our own brands are starting, whether it's 20 Dresses on the left-hand side or Naked renderings on the right-hand side. And then finally, the last slide we have here is in fashion. We will also start opening our own fashion stores this year. These will be stores where we will sell our own brands, but they will also be curations of third-party brands that we think are very interesting and form a cohesive story. They'll also be destinations where we'll list out some of our import and our global brands. I think what's most important in these stores is that they're differentiated and they're truly a destination that people want to come to. It's a bit too early to say how many of these stores we'll do or exactly what the format will be. But what I can say is we're piloting and starting with 2 or 3, and we're trying a bunch of different formats. And basis that, we'll kind of accelerate from there. But in a nutshell, I do believe in omni-channel, and I do believe that physical stores have a role to play in fashion. To what scale is something yet to be seen. So with that, again, happy to answer questions towards the end. But for now, I'll hand over to Vikas to take us through Nykaa Superstore. Thank you.
One of our new initiatives is the Superstore by Nykaa, our B2B business that aims to serve the underserved retailers across the country to source beauty, personal care, and wellness products in a convenient and a reliable manner. I'd like to introduce Vikas Gupta, CEO, Nykaa Distribution and Nykaa International, who's based out of our newly inaugurated Bangalore office. He has had a distinguished career spanning over 2 decades in leadership roles across the world with brands like Unilever and most recently Flipkart. Vikas, over to you.
Thank you, Brinda, and good evening, everyone. Thank you for the opportunity to talk about Superstore by Nykaa, which is the new B2B business that we have been building for the last few months. Let's start with the market overview. And it's the same chart that Anchit showed earlier. This is the beauty and personal care market projection over the next 5 years. And we believe that market is poised to grow double digits, 12% CAGR over the next 5 years, led by organized business and e-commerce in particular. But the key bucket here is the indigo part of the bar, where you see that a sizable chunk of the market, close to 50%, will continue to come from unorganized trade, which is the general trade. These are the neighborhood stores that you see around you. So that's the part of the market which is going to be substantial and growing over the next several years, which is the playground for Superstore by Nykaa. The current distribution ecosystem that caters to this unorganized part of the market, we believe that has quite a few pain points and is fraught with many inefficiencies at the moment. So on the left-hand side, if you look at from the distributor's perspective, we have a fragmented distribution system in the country. So typically a brand or a company appoints a distributor to cater to the demand in a particular city or a part of city. Just to give you a reference, the largest FMCG company in the country has almost 5,000 distributors. So by definition, these distributors on their own remain small. And that's why there has been very little innovation or capital infusion that has happened over the last few years in this ecosystem. The other thing to note about the distributors is that while they make a reasonable ROI, but the cash generated out of this business is fairly small. And that, coupled with the fact that it's a hard business and the opportunities that the younger generation has in terms of employment have quite increased quite a bit in the country, we see that the next generation is not interested in continuing with this distribution business. I've seen that happening, with my own eyes, that a few years ago there used to be a long waiting list of people wanting to be distributors, and now if a distributor goes under, it takes several months to find a suitable replacement. So a lot of headwinds on the distributor side. If you see from a retailer perspective, the retailer continues to remain underserved, and there are a few key points. First being the fill rates. The fill rates continue to be poor, and they are poorer in the beauty personal care categories because these are the categories which are high on SKU complexity and very high on innovation pace as well. So these distributed stock points that are there in the country, all small by themselves, are unable to keep pace with this level of innovation, and hence the stock outs at the retailer end remain a real thing, resulting in a loss of sales and revenue for the retailer. The second thing is on the poor credit coverage. And again, in my personal experience, I've seen even the best distributors, which probably give credit to 60-65% of their turnover. Numerically, they are able to give credit to not more than 35% of the retailers. That means 2/3 of the retailers do not have access to credit, and hence they are not able to grow because of working capital limitations. So that again remains a key pain point. And of course, as you know, that beauty, personal care, and wellness categories have seen a lot of innovation, a lot of proliferation of new brands, new categories have been introduced in India, and these retailers, have a very limited access to some of these new brands, despite their consumers asking for them and there being a demand. Last but not the least, it is not a level playing field. I mean, all of us know that distribution networks take decades to build, and they serve as an entry barrier for any new entrant. And the large FMCG companies do enjoy a disproportionate advantage on account of having created these distribution networks. So all in all, put together, we believe that this space is ripe for a technology-led disruption, and that is where Superstore by Nykaa comes into play. Superstore by Nykaa is a one-stop e-commerce platform for the retailers. So we buy directly from the brand, and we bypass all the middlemen and supply to the retailer using a digital interface in between, which is an app called Superstore by Nykaa that the retailers can download and register onto. We are focusing on beauty and personal care categories and wellness categories. because we believe that, compared to the other categories, they are more underserved. And of course, Nykaa has, inherent advantages in that category. I'll talk more about that in the subsequent slides. But, that's our vertical focus in terms of categories. The other interesting choice that we have made is, while we are serving the kiranas, which are a good go-to channel for any new distribution network, we are building engagement and presence in what we are calling underserved trade channels beyond kirana as well. So here we are talking about beauty stores. These are your neighborhood chudi bindi stores, fancy gift store where women go and buy makeup products, fragrances, beauty products. They buy innerwear, they buy accessories like hair bands and clutches, and also some gift items and even plastic boxes, etc. So that's a very important and relevant channel for these categories. The other exciting channel that is emerging very fast is the pharmacy channel, aided by COVID, where a lot of pharmacies have deepened their relationship with their customers, and they are now actively expanding the selection they carry and the product repertoire. And we are helping them with that, with this initiative. And last but not the least, even salons, which are again, trying to expand their monetization from their footfalls beyond services, and acting as a reliable channel which can sell their consumers beauty and personal care products. Our value proposition is multifold, and let me just show you a video which talks about our value proposition as seen from the retailer's point of view. Can we play the video?
आपको नहीं लगता ये ब्यूटी पर्सनल केयर वाला बिजनेस अब काफी जंजाल खिचड़ी हो गया है? इतने सारे ब्रांड्स, जिनके कितने सारे सेल्समैन, एक तो मिनिमम ऑर्डर का प्रेशर, और फिर हर रोज कोई ना कोई नया लॉन्च, ऊपर से हर ब्रांड के अपने अलग अलग मार्जिन, अलग अलग ऑफर्स। समझ ही नहीं आता क्या खरीदूं। और आजकल तो ये भी पता नहीं चलता कि लोग ऑनलाइन क्या क्या नई नई चीजें खरीदने लगे हैं। पर अच्छा हुआ मुझे सुपर स्टोर बाय नायका मिल गया, कस्टमर्स का फेवरेट। अब हमारे जैसे बिजनेसेस के लिए भी एक ही जगह से सारे बेस्ट सेलिंग इंडियन और इंटरनेशनल ब्रांड्स, जो और कहीं नहीं मिलते। जितना जरूरत हो उतना ही लो, और जब जरूरत हो बस तब। फटाफट मार्जिन कंपेयर करके ऑर्डर किया, और ऊपर से क्रेडिट फैसिलिटी अलग। और तो और सुपर स्टोर आपको यह भी बताएगा कि आपके एरिया में लोग क्या खरीद रहे हैं।
So apologies for people who don't understand the language. I'll quickly summarize the value proposition. We start with the fact that it's an all-in-one store. You can find all the brands that you need, even the selection which was difficult to find, typically in your city distributors. So no need to engage with dozens of single brand salesmen. No need to go to wholesale market to get access to your brands. So it's very convenient and a one-stop shop for all your beauty, personal care, and wellness needs. It is aimed at, so we are building a model where we can deliver superlative service to our customers. Of course, it's a doorstep service. We are trying to see if we can, how much we can expand our next day delivery, to the customers. In most cases, it's an open delivery because that's the requirement from the customer front. We are partnering with like-minded NBFCs, which are building, great products using technology and data to provide much higher levels of numeric credit coverage to our customers. And of course, other benefits like quick returns, etc., that the retailer might require. Super flexibility, again, you get to choose what to buy, how much to buy, and when to buy. So no more the possibility of getting manipulated by a brand salesman who ends up selling you too much, blocking your working capital, and potentially, suffering a sales loss because you couldn't buy some of the other products. So, again, a multi-brand distribution platform allows them the super flexibility of buying what they want when they buy. And of course, the super earnings. I think this is a a transparent and unbiased recommendation and advisory engine where they can figure out what are the categories, brands, products which are selling in their neighborhood, and they can follow the recommendations given by the platform. And of course, transparent pricing. So essentially what we are creating is a democratized distribution channel, which is powered by advisory, advocacy, and transparency. Our right to win, we believe, comes from who we are, first and foremost, but also by the choices that we have made. So of course, we have intimate understanding of customer purchase behavior in beauty, personal care, and wellness category. I would go on to the extent of saying that we are uniquely positioned in the country. No other brand has that kind of understanding. No other platform has the kind of understanding that we have of the consumer purchasing behavior, the trends in this space. We have very deep, sustainable, and strategic partnerships with across the brands in these categories. And of course, Nykaa's name is synonymous with authenticity and beauty expertise. Now, that's a great platform. And on top of that, what we have done is we have restricted our focus on beauty, personal care, and wellness categories for some of the reasons that I just talked about, but also the fact that these categories happen to be some of the most value-dense categories and high-margin categories, and which will hopefully allow us to build a sustainable and profitable model in the fullness of time as well. We have talked about the underserved channels. The other element that we are building is the platform is focused on delivering service excellence and not focusing on price discounting. Now, that's again something which is in Nykaa's DNA. We are passionate about building sustainable and profitable businesses centered around the customers. And it also happens to be a key strategic priority for all our brand partners, because in these categories, nobody likes price disruption in the market. And that's a key part of our agreement with our brand partners. I'd like to give you a performance snapshot, but keep in mind, these are very early days. We only started our pilot last year in August, and we started scaling up only in December onwards. So really, we are talking about last 6 to 7 months of data. And we believe that these early days of performance are showing a strong product market fit. We already have 45,000 transacting retailers from more than 500 cities. Our GMV has grown very rapidly, ahead of our estimates. If we can move to the next slide, just to give you a bit more color on these numbers, 80% plus of our sales are coming from tier 2 and below cities. Now, that again, talks about the underserved parts of the country. Clearly, there is a gap in the market, and Superstore is able to get more bang for the buck in tier 2 and below cities. The underserved channel focus that I talked about, that again is proving, the numbers are proving that we were right in putting that as a strategic priority, because 2/3 of our sales are actually coming from the non-Kirana channel. Within this, the beauty stores that I talked about, the AOVs is 20% higher than what we are getting. Order is about 25% more than what we are able to drive on the platform. So underserved channels clearly, more valuable at the moment as we see them growing across the country. The other thing is in terms of new versus repeat customers. As you can imagine, in early stage of business, we are on an active customer acquisition trajectory. And even with that, the repeat customers are forming a key part of our sales month on month. These are last month's numbers, May numbers. So 2/3 of our sales actually came from repeat customers who are more valuable and order more frequently already. The other thing that I would like to talk about again, these are the use cases that are emerging in our short existence so far across the different kinds of brands that we have. This is, the kind of incremental value that we are able to deliver to these brands. So starting from the top, I think for DTC brands, for challenger brand, it's a no-brainer. All the brands have, from day one, they've been wanting to partner with us, and we are giving them a ready-made access to our distribution network, which is data-driven, very transparent, and they're loving it. So that has been going very well. But even for the large FMCG brands, the HULs and P&G, Marico and Dabur and Bajaj and all these people, we are able to give them, very strong incremental value creation cases. So whether it is in terms of the top-up purchases that the retailers are able to make because they have the flexibility to order anytime, the tail SKU turnover that we are able to drive because we have a scaled-up supply chain as opposed to the fragmented stock points they have with their local distributors. We are able to drive non-core innovation for these brands, so much so that Parachute recently launched their onion hair oil, and they gave us 1 month head start, where we were the exclusive distribution channel for them to launch this product in the market because of the kind of channel, the kind of outlets that we were able to reach, which their existing distribution network was unable to reach. Premiumization, again, Dabur is a great case study where Fem and OxyLife is a small part of their overall franchise, but on our platform, it performs disproportionately. And even at our small scale, at the moment, we are already a key account, a key distribution channel for them for these Fem and OxyLife, which are more premium, more value-dense brands from Dabur's perspective. And of course, access to non-core channel. A lot of these companies are great at kiranas and maybe some other channel. But just to give an example, Marico, we are giving them access to beauty stores, and that's where we are able to sell their value-added products and variants like moisturizing creams and lotions, which their existing distribution network is not able to sell as much. Makeup brands, again, I think makeup, as you will be aware, it's a highly fragmented category. Top 10 brands contribute to a smaller share of the overall market. It's high complexity category because of the long tail of SKUs, very high touch. There's a lot of education is required at point of sale. So that makes us the ideal platform for them. And a lot of brands are partnering with us, and we are able to give them the kind of scale that they would not have got on their own. So Blue Heaven, Swiss Beauty are two examples, but even our own brand, Nykaa Cosmetics, we are able to take it to many more doors, making it a truly national brand in the making, in the physical channel as well. And of course, the regional brands, again, we are partnering with brands like Kumarika, Joy, Kiyokapin, which are great brands in the regional, from a regional perspective, but we are able to bring them to a national retailer base in a ready-made basis. Just a couple of slides on how we are building this business at the right pace and very strategically making some clear choices. The first is about the number of brands itself. We already have 150 plus brands, and that is across the categories, as you can see on this table, and across the type of brand. So whether you have the HULs and PNGs and Marico and Dabur, at the same time, we have the VLCC and Indica and Nile and Blue Heaven and Spins and Layers. We have all the DTC brands that I just mentioned. They are very happy to partner with us. Mamaearth, Wow has just come on the platform. Regional brands, and of course, imported and owned brands where we see relevance in the GT market. Now, this is a growing core that we have already developed. I mean, a typical retailer carries about 200, 250 brands in these categories. So, the core has already been established and it is growing organically. But now we are putting specific focus on building high value, relevant selection to niche channels in premium categories. So, categories like mom and baby, sexual wellness, feminine hygiene, nutraceuticals, supplements, and so on, because they talk to these underserved channels that I mentioned about. I think while the brand part is probably a little easier, the exciting part is to build, the B2B relevant and fit for purpose supply chain. Excuse me. And this is a very interesting problem statement that we have, that we work on, practically every day. 3 principles on which we are building the supply chain network. First is being close to the customer. We want to reduce the number of miles that the product travels, and that will obviously help with the SLAs. That will help with the shipment cost, and that's why from day one we are following a distributed warehousing strategy. We already have 6 warehouses operational and many more on the anvil. The other one, which is a key value proposition for us, is driving very high levels of fill rates, because that is where we really want to differentiate, and that will be a point of superiority for us. And that's where we are building superior analytics, strong technology to reduce out of stock and build high demand predictability. The last one is even more interesting challenge, because it's a daily trade-off between what is the maximum level of SLA that we want to bring, which is still considered best in class, and the cost. And that is where it's not a one size fits all solution. It's a very fit for purpose hybrid logistics model that we are building, which is designed by city type and customer type. And of course, we are a technology company at heart. We are building these systems and processes from ground up. Is absolutely at the center and the forefront of it. The other part is, while our app is the dominant interface driving end-to-end customer journey, right from onboarding to ordering to post-order experience, but we are using the other channels judiciously. So we have put feet on the ground. We call them business development executives. These are the ones. Think of them as a marketing channel for us to acquire and handhold retailers in this transition of habit change, from offline to online. We are building telesales capabilities as well to supplement these BDEs so they can further drive upsell, they can drive frequency of ordering and manage the loyalty program. And we are also simultaneously building a complementary channel around local PR and performance marketing to drive sales and customer acquisition and growth in the non-BDE territories. So again, technology is guiding a seamless customer journey, and the investments that we see in this customer acquisition and growth are similar or even lower to the early stage digital businesses which Nykaa itself has created in beauty and fashion. The other aspect is building the business sustainably, and like I mentioned, that is in Nykaa's DNA. And that's something we are very passionate about. So just to take you through a couple of slides on what are the unit economics from a store perspective. So we believe that for these categories, 1.5 million outlets is really the universe, which will account for almost the entire beauty and personal care and wellness categories. In phase one, we want to go after the top third of these outlets, which, applying the Pareto principle, we believe will give us, access to 60% of sales. And these outlets will have a larger throughput per month. And we believe that, that gives us about a $3 to $4 billion GMV opportunity that we can gun for and aspire to in the fullness of time. In terms of the P&L, what we have done here is that we have consolidated various industry reports on the eB2B platforms. And think of this as a consensus view of what eB2B platforms can generate as P&L at scale. We believe, looking at this number, so we're talking about 10 to 12% of gross retained margin, and that translates to a 4 to 6% EBITDA. We believe that at scale, the costs that we are talking about, whether it's in fulfillment, S&D, other overheads, and monetization, they're very feasible, and we can make that happen. I think just one chart before, just one piece of news, good news that I want to give is that our starting point in the short existence that we have had so far is better than what is there in the extreme left of this chart. So we are starting at a better position as we build this business. Even on the investment front, while we are talking about EBITDAs or what you saw in the previous slide, it's an investment-light business model in steady state. So if you look at the inventory or the working capital, because the per SKU throughput is higher, the SKU complexity versus a B2C business is a fraction in the B2B business. We can actually get, and we are getting a similar kind of credit from brands that we get on our B2C business. We believe that the working capital here would be much lower. Also because, for the same reasons, because the per customer throughput is higher, and per SKU throughput is much higher. The capex required as a percentage of revenue will be much lower as well. So once we are able to absorb the cash burn that is required in the first few years, we believe that it will be a much lighter investment model, and that will make it a high ROI, high ROCE business in the fullness of time. Just the last chart, these are the 5 key pillars that we track, key success factors, which we believe will put us on the right path to achieving scale and profitability. Of course, we have to continue to accelerate our customer acquisition. We have to make sure all the customers that are acquired, the repeat behavior is growing, is sticky, is becoming more valuable. Gross margin is an interesting territory because all sorts of levers here are at play in terms of mix of categories, mix of brands, the kind of value-added services that we are able to provide to the brands, and what is the kind of monetization that we can get out of that. The service level versus the fulfillment cost, that trade-off, like I mentioned, it's a daily challenge. It's a design challenge that we are very excited about solving. And of course, inventory cover, while at the same time delivering very high fill rates. So yeah, we're very excited about this business. Back to you, Brinda.
Thank you, Vikas, for the presentation. I'd now like to introduce Arvind Agarwal for our next session. Arvind is the Chief Financial Officer of our company. He has over 2 decades of experience in various fields, including accounting, finance, regulatory, and strategic planning. Prior to joining Nykaa, he was associated with companies like Amazon, Vodafone India, Tata Teleservices. Arvind, over to you.
Yeah, thanks, Brinda, and thanks, Vikas. So I'll take you through the financial, but I guess you have seen the charts during our earnings release. So I'll focus more on trends and qualitative aspect. The first chart is on revenue, consolidated revenue at Nykaa group level. And as you can see, we have grown 55% year over year. And this is despite 2 COVID waves during Q1, wave 2, and Q4, wave 3. Obviously, this also has a base effect because the impact of COVID was even heavier last year. But I think the overall our trend on revenue, we have grown ahead of the market. So that's very good, impressive performance on revenue. Revenue growth is lower than GMV because it goes back to accounting, different operating models. Fashion is predominantly marketplace, and only commission is accounted as revenue. And that part of the business is growing faster. Talking about the gross margin, as you can see, we have improved our gross margin by almost 470 bips. And there are 3 drivers to give us this improvement. This is driven by improvement in the own brand share, which is kind of bounced back to pre-COVID levels during the year. It's also favorably impacted by healthy growth in advertisement revenue, which grew almost 90%. And also part of it is also due to mix of fashion business, because fashion is accounted differently. It has higher gross margin to revenue ratio. Talking about EBITDA, in terms of absolute EBITDA, we grew EBITDA by 4% year on year. There is a lot of investment that we have made into new growth verticals, and I'll give you the breakouts later. In terms of margin, it has gone down by 200 bips because we invested into new growth verticals. Finally, on PAT, we are PAT positive company last 2 years, and there's a flow down impact of EBITDA, obviously on PAT margin, partly offset by leverage in the finance cost. Moving on, some of the trends that you can see on this chart. So left chart is more of year-on-year trend, and right chart is more of quarter-on-quarter trend. I did speak about gross margin, which is up by 470 bips year-on-year. If you look at Q4 versus Q3, it has come down by almost 250 bips, but that was expected because Q3 there is a lot of favorable seasonality, which also takes up a higher share on high margin products. If I talk about the purple line or the blue line, actually, this is marketing cost. So year on year, full year was 12.7 versus 6.9. Last year, we did not spend marketing to the level we would have done in a normal year due to COVID environment. So that's why it shows sharp increase. But obviously, we have targeted to acquire a lot of new customers, almost 6 million between beauty and fashion versus 3.6 million last year, and also spent on brand building across verticals. If you look at the quarter number, it was 12% lower versus last 2 quarters because we did brand building kind of mass media campaign in Q2 and Q3, which we did not do in Q4. Talking about the fulfillment cost line, Anchit did speak about massive expansion that we have done on the fulfillment capacity to get closer to customer. And on a full year basis, this cost has increased to 10.5 versus 8.9, but that's more an investment. And also because it takes time to get the benefit of scale and operating efficiency, which you can see on the right chart. Because by Q4, we have been able to adjust our supply chain and replicate inventory across regional warehouses and being able to deliver through surface transport versus we would have shipped it by air earlier. And also split shipment have come down. So it's already showing good efficiency by Q4. Finally, on the indirect expense or people cost, on a full year basis, if you see the left chart, we can see the operating leverage playing here favorably. So it's 8.6% versus 9.5 last year, close to 100 bips operating leverage. And this is despite the fact that we have hired a lot of new people, especially for growth verticals. But if you look at quarterly chart, that shows an increase from 8.5 to 9.3. But if you look at absolute number, it is almost similar level of 90 crore. So it's more of a deleverage that happens because we see a peak in Q3 and we see the best number as a cost to revenue ratio, and it takes time to show a consistent improvement, which I spoke earlier. It reflects on our yearly chart. Let me talk about these breakouts, and we gave this table first time to explain because different businesses are different stage of maturity and also different operating models. The core business, which is BPC, it grew 46% on NSV and 48% on revenue. So they are quite in tandem with each other, but we also get advertisement revenue, which straight comes to revenue line. NSV is more reflection of product sale, net of cancellation, returns, and discounts and taxes. On the gross profit, BPC has improved gross profit by 300 bips, and I already explained the drivers behind it. But good to see that it has maintained its EBITDA at 8.2%, quite similar to last year, despite a much heavier investment to marketing to acquire almost 50% more new customers, and despite almost 40% capacity expansion on fulfillment centers, and despite much stronger rollout on physical retail network. So it has absorbed all these incremental investment and maintain its profitability. If I talk about fashion, it's early stage, it has scaled well, almost 2.7x of last year. And it has also reached to a stage of contribution positive. So if you look at some of the unit cost parameter, which is the bottom table, it shows very healthy profile about gross margin of 44% to NSV, which is similar to beauty. Fulfillment expense is also quite similar to beauty. That comes from, and this is despite higher return ratio in fashion as a category. And that's because its average order values are quite healthy. But if you look at marketing, it is 27.4% versus 9.5 in beauty. And that's expected for a new stage business where bulk of the business is coming from the new customers. And we also spent on brand building, as Adwaita explained. So we are contribution positive. It shows very healthy profile so far, and we are confident that operating leverage and marketing cost leverage will play over time. So while it is EBITDA negative currently, minus 11.9, we can already see employee benefit cost improving by almost 500 bips versus last year from 16 to 11. Finally, on others, which is new businesses like Superstore, Nykaa Men, and International, very early stage, but we have done higher investments. As you can see, EBITDA is minus 45 crore, so almost $5-6 million incremental investment to new verticals. Which is why if we look at blended EBITDA, uh, despite 277 crore kind of BPC EBITDA versus 190 crore last year, we have invested almost 85-90 crore in between fashion and new businesses, and that's why our blended EBITDA is kind of flat or just 4% growth. Moving on. I think this chart is self-explanatory. I did speak during earnings release also, and probably I can just summarize our annual performance for FY22. We have actually grown very well despite tough environment to operate. Retail business has surpassed pre-COVID levels. Own brand has bounced back to almost pre-COVID levels, and we acquired 6 million customers versus 3.5 million last year. And between beauty and fashion, we have also crossed 10 million trailing transacting customer base. So the growth drivers are quite impressive. And not only that, the quality of growth has been quite good. Gross margin has also improved due to improvement on brand share and advertisement revenue bounce back. Fulfillment cost and marketing costs have been higher than last year, but they are showing good trend towards the end of year. And I explain the drivers. And overall, in terms of verticals, BPC has maintained its profitability profile and have grown at almost 50%. Fashion has scaled very well, almost 2.7x, and become contribution positive. And new growth verticals are looking promising, especially the Superstore part of it. Yeah, that's the summary of our financial performance. Back to you, Brinda.
Thank you so much, Arvind. Now that you've had a chance to hear about the three distinct high potential businesses within Nykaa, along with Nykaa's financials, it's time to hear about how each of these contribute to the making of the larger One Nykaa strategy. I now invite our Executive Chairperson, MD, and CEO, Falguni Nair, to take over. Falguni, the floor is yours.
Yeah, thank you. Brinda. And everyone, it's a real pleasure to be here today explaining to all of you further deep dive into our strategies. I think I have very few slides because I think each of my team members has deep dived in their business. I'm just summarizing what our overall big strategic pegs are. And I think these are very obvious to you if you've been following our, if you've been following our growth and results over the last few years. So I think there is a clear diversification strategy playing out at Nykaa to address the larger TAM. And this is being done with a clear customer centricity in mind in terms of who is our customer and what are they consuming, or which is our product market, and how we can play more meaningfully in a more integrated manner in there so that our advantage continues to increase. So I think a diversification, not in terms of hopping around in totally unrelated fields, but more logically guided by either the product or the market fit or the customer fit. So I think with that, you can clearly see that where BPC was almost 98% of our business, it is now 72% of our business, and fashion is now contributing 25%. And in a similar way, other new businesses that we have seeded has begun with just about 2.6% this year. But each of this addresses a larger TAM. And we made a lot of effort to explain the total addressable market to you. Maybe some part of it only is addressable, but at least it's a largish market in each scenario. And that gives us confidence that this will allow us to grow our revenue in a meaningful way, in a direction which will be synergistic to what we do today. Next. I think here I just wanted to remind everyone of the kind of journey that we experienced for our beauty business, where over the years the business grew. First initially at 237% or 270% year on year, and slowly the growth came down to around 50% levels. Of course, 1 year of COVID where we almost lost 3 months was affected at 35%. But I think since then the growth picked up further to 50%. I think we will have a similar similar scale kind of play out. I don't mean in absolute scale terms, but there will be a similar trajectory for fashion, where I think we've experienced very high growth for a couple of years. Of course, fashion is a larger market. The growth percentages get reflective of that. Also, in every year, the situation is different. Like year 2020 was characterized by COVID with retail being shut. So all of that has an implication. But at a broader level, we see similar scale in terms of trajectory play out. When I say similar, please don't misunderstand. I don't mean exact percentages. I just mean that with scaling up, obviously the percentage growth does come down, and you will see similar growth trajectory for fashion going forward, and then other businesses in the long run. I think next. I think it's again one of the important strategy that is playing out right now is that post-COVID, we've accelerated the customer acquisition through investment in marketing. I think we've been talking about it for each of the quarters, and here the full year numbers are available to you. You can see that in beauty and personal care, we grew customer acquisition to 4.4 million, which is almost 50% growth over the previous year. And also we've given that accounted for about 27% of our new 27% of customers, total customers. And I think this led to higher marketing spend at 9.5% versus previous year, where actually the new customer acquisition was a little bit flattish over the previous year. Next, on the fashion side, also, you can see that we've acquired almost 1.6 million new customers. Again, acceleration in customer acquisition, and fashion customers account for about 74% of our customers. New customers in fashion account for 74% of our customers. And of course, as a result of that, our marketing spends have increased to 27.4%. I think the percentage marketing spend also reflects a mix of new versus repeat buyers, and I think that needs to be understood. So it was a very conscious strategy to increase customer acquisition, and I think we may continue to do that going forward. I think we would always look at mix between investing for the long term, along with also making sure that the health of our cohort remains healthy. Next, I think I just wanted to explain one more thing, that I think if one looks at trying to optimize every aspect that is on this table, it would be wrong. So I think, of course, we get almost 881 million customer visits in the year 22, and it has grown very healthily, but we may choose to sometimes work on conversion. Like you can see that in the year 22, our conversions have improved to 3.1% against 2.6% in the previous year, and almost it is higher than even what we had observed in year 2020. So we are clearly choosing to drive for better quality customer with more optimization of customer conversion. And we also want to continue to push for increase in repeat shares, which again, you can see here in the chart on the right, that this is all these examples are just for beauty and personal care, so that you can understand it in a deeper way, where we have in the year 22, in spite of so many new customers that we've acquired, still the new customer percentage went down from 30 to 27%, and repeat customer increased from 70 to 73%. So what we are trying to say is that we understand all the areas of the funnel, the top funnel, the middle funnel, the lower funnel, and instead of trying to grow everything in a similar percentage every quarter or every year, I think we try to achieve our long-term objective of adding to the cohort, ensuring the health of the cohort, and maximizing what we call as long-term value of the customers on our platform, as well as also optimizing for near-term value that we extract out of that customer base. And this to us is an optimization that we do. And I think I just wanted everyone to understand that it's an optimization rather than trying to drive each of the elements by a similar growth. Next. And I think similar optimization is being pursued in fashion also. And of course, it's on a smaller scale. and hence it tends to have a little bit wider implication on growth and cost of marketing. But clearly, we do feel that we have a lot of visits on the website, and we are playing increasingly towards conversion. And you can see it here. We have tried to give orders on the right scale, but similar scale, and on the left is the visits, and you can see that even if you feel that the visits are not going up, the orders are going up. And I think some of these are very conscious strategies. Of course, this is also complicated by whether it's a season, off-season, in-season, sale, non-sale. There are many complications here, but we've tried to put data so that you can see that this is a very conscious activity at Nykaa rather than trying to just grow everything, because there are otherwise implications on what it ends up being. I think on the right, there is also a table we've given about existing versus new customers. So in spite of very large number of new customers being acquired, the existing customers, which are customers which were there at the beginning of the year, were at about 26% of our sales, and the new customers were at 74%. So again, talking about healthy customer retention. I think next, I just wanted to talk a little bit about our own brands. I think our own brands are a very important part of our business, and we've started sharing more information, but I think they are showing very healthy growth. And you can see that in beauty and personal care, our own brands grew at 61% year on year, and they now account for 11.2% of our GMV. We have not included Earth Rhythm turnover in this since it is a minority stake. But Dot & Key and K Beauty, which are majority stake, are included in this. On the fashion side, similarly, our own brands had a very strong growth of 215% year on year, and their share on the platform has grown to 7.8%. And like you're aware that we did acquisition of Nykaa, which is included here, but we tend to acquire small brands, so it's not like growing. We are not buying turnover. I think we are trying to buy interesting businesses that we are ready to scale with effort that is being put in at Nykaa towards building those brands further. So with that, I think these are the main areas of our strategy. Sorry, one last one I wanted to add was improving unit economics through a strategic focus also is a clear strategy at Nykaa. And for that, I wanted to show you the full year. I mean, unfortunately, we can't share too much of forward-looking information. And hence, what I'm trying to do is I'm trying to show you the full year of 22 as well as Q4 of 22, which are both in public domain. And what we are trying to highlight is that in spite of good results for the year, there continues to remain improvement during the year, which is not really reflected. Which is at a bit, which indicates that we have improved margins and other things further. So, for example, if I may point out, the fulfillment costs for BPC for the full year was at 9.6, but by Q4 has come down to 8.6%. I think just show at the top in the key expense ratios to revenue on Kit. 8.6%. So 9.6 has been further brought down to 8.6 by the end of the year. Similarly, marketing and advertisement expense, which for the full year was 8.6, has been further brought down to 7.3 by the end of the year. And of course, employee benefit expense went up by the end of the quarter because of the last quarter reasons. Similarly, if you look at, and that led to improvement in EBITDA margin. Full year EBITDA margin for beauty was 9.1, but if you look at the Q4, it was 10.1. Similarly, if you look at the key ratios at the NSV level, whether be it gross profit margin, of course, gross profit margin for the full year is at 44.3. I can't say we improved it for the whole business by the last quarter, but clearly fulfillment expense, you can see, irrespective of all the three categories, beauty, fashion, and other categories, we have improved fulfillment expense down from 10.7 to 9.8. And similarly, marketing and advertisement expense has come down from 12.9 to 12.1. And yes, in some cases, there's a slight increase, like fashion has gone up from 27.4 to 28. These are small increases. We tend to have unit economics clearly in our mind, and we work towards achieving optimal unit economics over a period of time. So if that was my last slide. And these are the key areas of focus from a strategic perspective. With that, I think we can open it up to question answers. And thank you everyone for being here with us today.
Thank you so much, Falguni. It's always great to hear from you, and we're really excited about Nykaa's journey ahead. With that, we conclude the first half of the Investor Day. Thank you to everyone who's added their questions. We have some really good questions. We will begin the Q&A after a 5-minute break, and we'll, of course, try our level best to answer all the questions. And we'll go for a break now. We'll start in the next 2 minutes. Welcome back. We have our questions ready. We have some really good questions. We'll just get right into it. First question is on fashion. 10% of the online fashion market share by FY 2025. Is that an aspiration or a guidance?
Yeah, I can take that. No, it's definitely not guidance. The point I was trying to make was simply that, to have a meaningfully sized business in fashion in the Nykaa context, one doesn't need to get to some very large percentage of market share. At any percentage, whether that's 3, 5, 10%, this is a very meaningful business in terms of size and scale in our scheme of things. And that's just sheer reflection of just the size of the market, the size of the opportunity, which is anywhere between 5 to 6x the size of beauty.
The second question is on Superstore. By when do we see 3 to 4 billion GMV possibility that you indicated being crossed by Nykaa?
So again, I think just to clarify, the number that we put there was more to capture the unit economics, seen from the perspective of a store. So the 3 to 4 billion that we put was, the addressable market that we have, let's say in the first phase. It was not to indicate that that's the target we are aiming to reach. So just to clarify.
So I think for everyone's benefit, we've taken these two questions right at the beginning to explain that these are not our revenue targets, and it is more about trying to quantify the size of the market that we are addressing, and what a part of that is what we would aim to hope to get over a period of time.
The next question is on beauty. How do you see the GMV share between beauty and personal care over the next 3 to 5 years versus where it is currently? And what does it mean to gross margins?
Can I request Anchit to take that question? I think it's an interesting question.
Yeah, sure. So I think it's a very good question. And what I would say is that, the reality is Nykaa has been the dominant player on the beauty side of beauty and personal care. And it is, there are, and it has had a sizable business in personal care, but clearly our core has been on the beauty side. So what we've realized is that beauty customers are also personal care customers. And, the number of times in the frequency with which they purchase personal care items is much higher than the frequency with which they purchase beauty items. So we thought, why can't we become that singular destination for our beauty consumers and cater to their personal care needs as well? So we see it as very additive. And we see it as a way to increase the frequency with which our existing customers are interacting, engaging, and transacting on our platform. That's one. The second thing is, the reality is in India today, there are personal care is a larger part of BPC than beauty. And that is how BPC markets tend to look in the early days of their maturity. But as they tend to mature, they tend to weigh more heavily towards beauty versus personal care. And you can see that in countries such as whether it's China or South Korea, or clearly in the West as well. So that trend is underway. As I said earlier, beauty categories are growing faster than personal care categories. That being said, in India, there are a large number of consumers today who are not beauty shoppers, but they are personal care shoppers. So personal care is another way for us to acquire customers into the funnel and make them into Nykaa users. And then over time, using all the tools that we have at our disposal, including CRM, to drive awareness, education for beauty and convert them into beauty shoppers as well. So that's how we think about it. I would also just caution that it's not really beauty versus personal care in that sense, where also the way Nykaa positions it is that personal care for us is what we consider as Nykaa every day. So basically, they could be makeup SKUs or skincare SKUs that are just used at a higher frequency than some of the more premium items. For example, we consider a face wash. A face wash could be considered as a personal care item because of the frequency with which it is used. So I hope that answers the question. In terms of the margin impact, we don't really see there being a margin impact because a lot of the personal care brands in the market today are from large FMCG companies who do have very meaningful advertising budgets. And so when we look at gross margins, it's a combination of product plus advertising margin. And we think that there should not be much impact on our overall gross margins with personal care, with us making a big push into personal care.
The next question is again on beauty. Given that you have private labels as well as import brand portfolios, how do you ensure that the marketplace is still neutral overall? Are we now approaching a point where most brands simply have to partner with Nykaa because of its size and online presence?
As I said, we list over 3,000 brands, domestic and international, of which, maybe 20 to 30 of them are part of, only really 10 of them are, less than 10 are part of our, what we would call own brands portfolio. So it's a very, very small part of the pie. Also, if you look at the revenue contribution, no single FMCG or CPG company has double-digit market share of our revenue. So we've got very diversified revenue. We are also a very large contributor to large companies in India. To most beauty companies in India, we contribute a significant amount of their online revenue. So what we always like to say is that we are consumer backwards. We will list and we will curate those brands that our consumers want, whether they are imported by us or not. They will be listed and they will be given the due visibility that they deserve by Nykaa. We also say we're an equal opportunity retailer and platform for all. What that means is that to be visible on our platform, it's an equal opportunity for every single brand, whether they are third party or not. It's an equal opportunity. Everyone, including our own private brands, have to pay to play, in the sense that they need to, we have to buy visibility on our assets, on our platform, you need to obviously pay according to that. And that is the same for everyone. It's a totally fair, equal opportunity platform. So no, I think given that we are highly diversified revenue mix, it's a very open, transparent platform. We work in a very transparent fashion with our own brands. There is, in many ways, a Chinese wall that exists between the multi-brand retail business and the private brands business. And we've delivered a tremendous success to our brand partners. And the fact that, we are a very unique platform where third-party brands can actually do a lot of brand building and help to extend their brand equity and drive awareness, given our focus on content. And the fact that we don't discount, we don't do any retailer-funded discounting. So we allow the brands to really maintain their positioning in the market. And I don't know how, whether that can be said about all the e-commerce platforms out there. So I think brands see this, they value it, and as a result, they've chosen to partner with us in the numbers that they have. So that, I think that kind of answers the full question. Thank you.
The next two questions are on fashion. The first question is, what's the physical presence looking like? How many EBO stores are we thinking of in the next 3 years?
So as I mentioned while I was speaking, today we have one store, which was just a bit of a pilot, an opportunistic store that we opened last year. Over the next month or two, you'll see a couple more stores. We're trying to experiment with a couple of different formats to see what really clicks, both in terms of size and merchandising mix. Basis that and basis the success we see in this first leg of stores over this next year, we'll sort of set our ambition in terms of how many stores and what percentage of business. But as of now, it's a bit early to say.
And the second question is, what is the difference between international brands and import brands?
Yeah, so it's a slight difference. International brands are already brands that are international and global in nature, but have existed in India, so they have distribution already in the country. So if you think about it, Adidas, a Puma, a Reebok, a Forever New, Forever 21, these are brands that have been here. When we look at import, these are brands that are not in India, but we have an import team that is going out there, traveling the world, whether it's the UK, Turkey, US, going and pitching to brands and bringing them into the country. And we are that one-stop provider that brings them into the country and then does their sales in the country.
The next question is on eB2B. JioMart and Udaan are also offering products to customers, providing credit and etc. How will Nykaa's service differentiate versus these other two players?
Can I request Vikas to take this question?
Thanks, Falguni. So I think, it's a big market, first of all. And, the distribution ecosystem that we talked about, it's a huge market. And, it's but natural that there will be multiple platforms that will try to, play in that market. In fact, in some ways, it is good that multiple platforms drive that market development and that habit change from offline to online. I think platforms that you mentioned, Udaan, Jio, etc. I think they are focusing, in their own manner on the categories, that where they have the right to win. We are focusing on categories like beauty and personal care and wellness, where we believe we have the right to win. We have the requisite amount of expertise. We have the partnerships, and that's the value that we can bring to the retailers. I think the other elements of the equation, as I mentioned in my presentation as well, the channel focus that we are bringing, kiranas, but beyond kiranas as well, and of course, leveraging the granular and proprietary understanding that we have of customer behavior, at an area level. So I think all of these things make us believe that amongst this opportunity, which is large, we will find our play as well as we go forward. Of course, at the end of the day, execution is the key. Strategy is one thing, but really executing on a daily level and making sure that we are building the right kind of engagement and equity with our customers. I think that's going to be the key success driver from here on for us.
Follow up on eB2B. Will Nykaa provide credit directly or simply rely on third-party NBFCs to give credit to kiranas?
So we are working with, like I said, like-minded NBFC partners, and there has been a lot of innovation in this space in the last 8 to 9 months itself. So we are working with 2 NBFC partners already, Flexi Loans and Rupify, and we are working with another 2. So we want to, but the entire customer experience is going to be seamlessly integrated on the Superstore app. So for the customer, it will be the whole Nykaa experience, but it's completely outsourced to a partner. We will be paying them a fee for the credit that they provide us, and everything else in terms of due diligence, vetting, recovery. Everything will be managed by this third-party partner.
I also just want to proactively come in here and add one more point that I saw amongst the question. I think someone was asking that, since we are in B2C business, by enabling retailers to sell the beauty products, would we not eat into our own business? And I think the beauty and in terms of the potential for beauty business is so large, the consumption is so low, that we do not believe that there would be cannibalization. There will always be unique products and brands that will continue to sell much more at Nykaa. And I think our Superstore business will allow us to have a reasonable play on brands and SKUs where we were not a very meaningful player because those were not very suitable SKU for regional shipments or customer was not ready to buy them once in a while, and I think there was a tendency to buy it differently. So I think it's a strategy that has to be looked at the brand and SKU level, and I think there is a clear incremental value add that Nykaa will bring to the ecosystem, and through that will be a incrementally meaningful business for Nykaa rather than cannibalizing of what we already do well. So with that, I hand it back to you, Brinda.
The next question is, what is the total deliveries to order ratio in BPC? What is the percentage of total air shipment to total deliveries percentage?
Can I request Arvind to take this? I think there was a little bit of this in his presentation slides, but he may need to elaborate on it a little bit more.
Yeah, I will come in. So I think we have shared the trends and the directional aspects of how regional fulfillment strategy is helping us to drive down the air shipments and also controlling the split shipment. So while we have not published the precise numbers, but in an ideal situation, order to shipment ratio should not be more than 1.1 or 1.15. So because if you are able to replicate the inventory effectively in all regional fulfillment center, you could actually match customer order to nearest supply center, and then the fulfillment ratio should be ideally around 1.1. I think we are not too far from there. It's already showing up in our Q4 number. But unable to give precise number on air shipment and split shipment.
I think, Arvind, if you'd just like just to add to what you said, we'll always have some degree of split shipment because one of the main reasons why we won a lot of the luxury brand partners with whom we work is guaranteeing that luxury SKUs will not be shipped in the same package as a mass or a masstige SKU. So to cater to to creating that luxury platform feel and to service our partners, we always separate those orders. So of course there are consumers who most consumers tend to have a mix of both luxury and non-luxury items in their cart. So to an extent that there will always be some degree of split shipment, but I think as Arvind said, ideally it's 1.1 or so, and we're not too far away from that already.
The next question is on fashion. Your gross profit percentage to NSV for fashion is at 45% with a largely marketplace model. Is 10 to 15% higher than the industry for like-to-like business model. Could you explain why you think brands will continue to give you almost half of the customer spend when other platforms will do it for 1/3?
So I think I wanted to come in a little bit here and then hand it over to Adwaita. From whatever I know about the industry, I think the margins in fashion are higher than beauty, and definitely the margins that we are talking about would be the margins for multi-brand retailers for fashion in offline market. So I don't think that's the right comparison. I think what has happened in the industry is that sometimes the online retailers have used the margin that they have available towards customer acquisition, and as a result, some of their net margins may be lower. And they would have given away some discounts in terms of acquiring the customer because there was a belief in the industry that it's a cheaper, you can let go of some margins to acquire the customer and save some money on marketing. I think Nykaa, like in beauty, doesn't do any margin funding from our balance P&L. Of course, there could be some small amounts of those for either loyalty or sometimes our own brands. But what I mean is we don't do brand discounting from Nykaa funds. There could be some coupons given for first-time users and stuff like that, but besides that, nothing. So I personally do not feel that we are chasing a higher margin than what industry permits. But with that, I would request Adwaita to come in.
Yeah, absolutely. So I echo that in that, first of all, this number, this 45% would include a bunch of things. So it's the complete take rate. So it includes the product margin, it includes any fulfillment charges, it includes marketing income, it includes a bunch of sort of services that are provided to the brand. And in my understanding and benchmarking across what other retailers are being able to charge, if you add all those components together, which may sit under different headings in different companies, it's a similar sort of take rate that one is looking at. And that's the information that I have. So I don't find that our numbers are very off what the industry is experiencing. And Arvind, who has experience at Amazon, can also chime in terms of what he's seen at other places.
Yeah, it's I think already explained both by FN and Advaita that because we are not a discounted platform, and because the assortment mix that customer buy from us tend to be slightly more premium, which is why our take rates are higher as a blended number. But as a market structure, we are not too different than the physical retail structure.
The next question is on eB2B. Can you please comment on the steady state economics for Nykaa Superstore, say 5 years out? Are companies like HUL giving you better margins than the distributors since you're buying in larger quantities?
Shall we go to that? Shall we project that slide again? The unit economics slide?
Yeah, may I request Vikas to take that?
Yeah. That's just coming up in a minute.
Yeah. So I don't think we are allowed to give guidance on what will be 5 years out, and that's why what we put out there is a view which has come from analysts and investors, in terms of what a steady state eB2B business might look like in terms of unit economics. So if you see this, we are talking about fulfillment costs of about 3% of revenue, and S&D and customer investments about 2.5%, and other overheads of about 2.5% as well. We believe that these numbers are feasible, they are plausible. I don't know whether it'll take us, what time frame it'll take, but at scale, these kind of numbers are possible, and we believe that we can reach that. So yeah, I think what we're essentially saying is that this consensus view of industry unit economics is something that realistically that we can chase at Superstore. I think the other element, and I see a couple of questions there as well, is, we do have a slightly better starting point. And the reason why that starting point is there is because of the category choices that we have made. Beauty, personal care, and wellness inherently has, better margins in the distribution chain. So the starting point is better. And there will be further levers of improving that gross margin beyond just the scale. At the moment, we are very small, so I wouldn't say that we have the scale to get additional margins. Hopefully, at some point, we will. But, there are other levers, because we are a data-driven, technology-driven business. We bring significant amount of targeting capabilities to these brands. So, if they had 100, money to spend behind trade promotions, they don't need to go after everybody. They can go it in a very targeted manner. Their return on investments can be very high, very clearly and transparently measurable. All these things give incremental value. And we believe, and already we are seeing that brand partners are interested in those kind of value-added services and willing to compensate us for that. There are other examples that I mentioned about, some unique launch, which we were given exclusively. It's because of the channel footprint that we were able to give the brand incrementally over what they would get in the conventional sense. So I think value-added services and these targeting capabilities would be one big lever. The other lever, which I think it has not been drilled into great detail for now, but that's something that is finding traction with the brand partners, because today the brands actually take care of the first mile and middle mile logistics when they supply to their local distributors. And the distributor takes care of the last mile. What eB2B platforms end up doing is that, we only get the brands are only taking care of the first mile. The middle mile and last mile comes, as part of the fulfillment cost of the B2B platform. So the middle mile, if we can get a reimbursement from the brands, that could be another lever which we are already starting to engage with our brand partners. The third, of course, is scale, but like I said, we are too small to discuss that at the moment.
think there was just a last question from Mansi saying, so you're comparing beauty to staples and it's not a apple to apple comparison. And this is precisely the point. We just wanted to make it clear in this presentation that our B2B business will have a different margin structure than what people may believe B2B businesses have. And we are not saying these are superior. We are saying that these are margins that are possible in this beauty and personal care business. With that, again, handing over to you, Brinda.
So the next question is, one of the reasons your BPC business does so well in small towns is that the products are physically not available in the stores. With the Superstore initiative, you're plugging the issue of physical availability, thereby cannibalizing your high margin business with a low margin business. What would you comment on that?
So I think I did allude to that earlier on a proactive basis, and I think we do believe that the number of SKUs we have on our website, I don't think any shopkeeper can keep all those SKUs in their store. So the B2B business has a very different, it has a very different play, more so for what we call as everyday items of consumption, and that we can send it to customers closer through the retailers and bring in retailers also into this digital ecosystem. I think it's a very positive work Nykaa is doing. Instead of dividing and making it retailer versus e-commerce, we are saying e-commerce and its capabilities will also enable retailers to do more meaningful business in their neighborhood. And I think it'll be win-win, since Nykaa will have a play in the entire ecosystem of beauty, and Nykaa will operate through all the aspects of the chain, and by doing so we will have a play in each of the channels that matter to our brand partners, and we become then a very important partner to our brand partners, because we can deliver them not just in e-commerce but also in physical retail as well as in their GTMT ambition. And not every brand considers GTMT, but for those that business is relevant, we will offer them much wider distribution, and that will allow them scale at which they can be more successful and be more meaningful, add more meaningful value add to the customers at large. So I think it's a win-win strategy in our mind. With that, Brinda, back to you.
Are we facing any inflationary headwinds on raw materials, packaging, etc.? If yes, are we passing it through price increase, and to what extent?
So I'm assuming this question is for our own private labels, and I would request Arvind to answer that, please.
Yeah, sure. I think the inflationary pressure on the input cost is more relevant for brand play, where we are manufacturer, and that part of business is about 10%. And in that equation, typically raw material to price ratio is 4 to 5x. So the overall, even if we decide to absorb that input cost coming out of inflation, it will be very marginal impact on Nykaa P&L as a whole. So that's on the brand side of it. I can also elaborate on retailer and the multi-brand play that we have on various cost lines and how inflation could pan out. So talking about fulfillment cost, for example, which is significant cost line, there could be inflationary impact on transport costs, on packaging costs and stuff like that. But we believe that through the scale efficiency and regionalization that we are driving as a strategy, we will be able to offset bulk of it because the unit cost will come down. And therefore, we should be operating at sub 10% level. So those are the two questions on inflation. Maybe back to Brinda.
Thank you. The next question is on fashion. We've seen some stagnation on visits, number of orders from Q2 to Q4. What is causing this, and how confident are you of ramping up these numbers over the next 3 to 5 years to match up BPC scale, as fashion is a bigger opportunity?
So, in terms of just the quarter-on-quarter growth that one has seen over the last couple of quarters, a couple of things. The first is that if you actually go back 5 quarters or so, there was a very sharp jump in consumption from Q4 21 to Q1 22. So that was an over 50% quarter-on-quarter growth. And so in many ways, the next couple of quarters were about stabilizing at that new level And I'm sort of happy to see that there was no degrowth from that new level that we achieved. So one element here is that there was very sharp growth in Q1. The second element here is that we did make a lot of choices through the latter 3 quarters, where it was very important to me that we were setting up the right unit economics and the right cost structure to deliver on contribution profitability, and make sure that even going into this year that we had the right unit economics in place. So it really was a couple of quarters of trying to consolidate on our marketing strategy, consolidate on our performance ads, trying to be very thoughtful about the types of products we were selling, just to make sure that we delivered the right unit economics. It would have been possible to grow the top line even further. But these were choices that we were constantly making in terms of, are we getting the right type of growth, the right quality of customer, and so forth. I do believe that growth will be there, even when we're looking forward into the next couple of quarters. But one thing to note is, of course, the 168% that you see from this prior year, in the prior year, that level of growth is not going to be there. And that's just the nature of a larger base and growing off that base.
Just to follow up on unit economics, the question is, while there is a definite moderation in marketing and fulfillment costs in Q4, this is for beauty and fashion, is this more seasonal or sustainable savings, especially on marketing, as customer acquisition will remain strong focus area in the medium term?
Sorry, I'll take part of it and then request Arvind to say that. Take the balance. Maybe Arvind can start and then I'll add 2 bits to it. Arvind, do you want to start?
Sure. Yeah, so I think I did speak about fulfillment, and we believe that the unit economics improvement is structural and sustainable, as you can see in our Q4 number. Part of it can be plowed back into customer experience, and part of it could be an offset against inflationary pressure. But still, the bulk of this saving of 100 bips odd should be sustainable. We should be able to operate at sub 10% level. Talking about marketing is still expected to be high as we continue to focus on acquiring new customer. It is also impacted by our choices to have right mix of brand building and performance marketing, and also a bit of seasonality from time to time. But I think in the long run, marketing leverage does play, because we focus on acquiring high quality customer and retaining, and work on repeat business growing as a share through our CRM initiative. And as you can see that in BPC, over 3 years, marketing cost has come down from 13.7% in FY19 to 9.5% as a percentage to NSV by FY22, precisely for the point that share of repeat business has grown from 55% to 73%. So that's how we should think about marketing in the long run.
I think Arvind has explained this very well, and I think I don't have much to add. But just to reiterate, what I would like to say is that there are 3 drivers to our quarterly numbers. One being there is a certain seasonality of our business, and that should be understood. Clearly, October to December quarter tends to be a very strong seasonal quarter, leading to definitely a much better economics sometimes, but also sometimes that is also a very strong quarter to do new customer acquisition. So I think one must understand that there are always balancing objectives here at play, and Nykaa is always trying to balance the 2. The second thing I would like everyone to remember is that the mix and the mix was causing a lack of understanding, and for that reason we have started sharing all our costs for beauty and fashion business separately, and also throw some light on investment that we're making in new business so that everyone can understand those better. And last, I also would like to say that there is an aspiration, which again Arvind explained, that there's an aspiration to do brand building. And every time we indulge in brand building activity, at our current scale, it does have some impact on our unit economics. And I think that is another area where we are trying to balance it out from period to period, but again, it's not uniformly spread out. So I think just wanted to throw some light on those, but I think Arvind explained everything very well. Thank you, Arvind.
So the next question is, content creation has been at the heart of beauty business. Do we have a similar content strategy for fashion verticals?
Yeah, I absolutely. I think we believe in both our businesses, both beauty and fashion. We have a role to inspire, educate, and help the customer discover the right products for themselves. And that same equal level of focus exists in fashion as it always has in beauty in terms of creating and churning out just copious amounts of content. So there's a lot of video, blog, influencer content being created. I'm also a strong believer that content and inspiration extends beyond just those traditional items of content. That is, things like video, social media, but there's a lot that you can do on site as well so that you're aiding discovery during the shopping experience. So I do like to think of content beyond just, traditionally what is termed as content, but more as on-site discovery as well. And so there's a lot of focus on that.
What is happening in Nykaa's international businesses? Could you explain, elaborate?
Yeah, I would just say that these are very early days for international business. We are just beginning with an effort and ambition to take our private label brands, especially the beauty brands, into international markets. So it's like an export type of an activity. Yes, we do. We may have, I wouldn't say we do, but we may have sometimes an opportunity to be a multi-brand retailer in a new market, and that will be carefully evaluated in terms of, is that the right market where we would like to go, and would that be in what format? And I think, but I would definitely say that these are very early days of international business, and we are taking baby steps at the time.
The next question is, AOV in BPC came off slightly to 1850 in FY 2022, still higher than 1450. What is the level at which this settles at?
Yeah, maybe I could take that. So look, I think there was a slight elevation in the AOV last fiscal in FY21, in large part due to some of the conservative shipping policies that we had put in place. The reason for that was clearly there was supply side constraints. There were constraints on the warehousing capacity because of obviously the pandemic and social distancing, etc. So that probably drove a little bit of the increase in AOV to 2,000 rupees plus last in FY21. Also because there was a massive increase in the online buying for especially more expensive items. So I would say that now that our shipping policies in FY22 have been pretty much at comparable to the rest of the market, we're offering shipping on very low average order values. Despite that, our average order values have not declined meaningfully and are hovering around 1850 as you mentioned. So given that we are where we would like to be from a shipping policy threshold perspective, and we've seen premiumization continue to, as I mentioned earlier in the presentation, premiumization continues to evolve and is a macro trend for us. So I think it's a relatively healthy place where we're at. And so I don't see much movement from here on the AOV for beauty at least.
The next question's on eB2B business. eB2B business is likely to require some investment with a potential 4% EBITDA margin. Are there any strategic benefits of doing this business for BPC segment? And why comment that working capital will be lower in B2B? Receivables should be able to pull this up.
So may I request Vikas to first explain the working capital and how it is meaningfully lower in this business, as a in general in the industry, and then we can talk about what is the reason for doing this business.
Right. So I think the two key factors are, one, the fact that our customer throughput is much higher. So the average order values tend to be much higher than in the B2C business. At the same time, the SKU complexity, we talked about 3,000 brands and 300,000 SKUs in the B2C business. Here, the inventory in terms of complexity will be materially less. So that means per SKU throughput is going to be much higher than it is for the B2C e-commerce business. So put together the inventory requirements in terms of number of days, it will be much lower than it is for the B2C business. While at the same time, the credit that we get from our brand partners would be of a similar level. So our overall working capital will be quite positive, as compared to the B2C business. The comment on the trade receivables, just to explain again that the two predominant modes of collections will be cash on delivery and credit. In both scenarios, we receive our revenue on the next day. So there is no trade receivable really in this business, because credit is a percentage of revenue cost. It's not the credit that we are giving. So it's part of the P&L rather than the working capital numbers. I hope that makes it clear. I think you want to add anything?
Yeah, I think, very often we take our inspiration from the real world business. And if you look at distributors in the real world business, these are small time distributors who make very small investment in the business and yet do reasonable turnovers, So I think we are talking about a business that doesn't need the working capital of the type that, say, physical retail business would need. And of course, e-commerce lies somewhere in the middle, So I think in that sense, it's a very efficient business from working capital and investment that it entails. Of course, there will be some need for warehouses, but again, I think everyone should understand that the investment in warehouses for our kind of business is a very small amount compared to this amount of turnover that goes to those warehouses, because these are all very fast moving SKUs, and they move out in and out of the warehouse pretty fast, needing much less investment in warehouse. And finally, to ask the question that why do this business? So we do believe that there are many brands that may choose to be only direct to consumer only and sell only online. And there could be brands that also need to be in physical retail to be able to educate the customer and build a business. And that's where our physical retail business is a very important tool for many of those brands to succeed. In our opinion, any premium skincare cannot really build a customer business unless it is represented in the store. So there is the stores and certain percentage of certain presence in stores, physical store is very much required to build certain brands. And similarly for GTMT, again, not all brands and SKUs are suitable for GTMT, but there is a certain consumption that is very widely spread. So if you look at makeup category, there could be a handful of 10-15% SKU, which may be suitable for GTMT distribution, but of course they will have very large size and scale in terms of business. So I think from our perspective, by offering all the three channels, we become a very important partner for our brands, both Indian as well as international, and we help them build their brand in a meaningful and sustainable manner. So we think that this is the right strategy for a dominant player like us in the beauty industry.
Why would HUL and other FMCG companies want to partner with Nykaa for personal care products when they have their own distribution network?
So I think we did address this slightly in Vikas's presentation, but I will ask him to repeat his understanding.
So in fact, since you specifically named HUL, HUL was one of the first partners who came on board, and they came proactively. And I think it comes from, an honest understanding of what the current distribution network is able to achieve and where the gaps are. So companies like HUL, which are very forward-looking and very strategic in their thinking, are able to very quickly understand the benefits a e-distribution platform can bring today and tomorrow. So, the use cases that we talked about, top-up purchases. So stock out and losing sales at the end consumer point is a real thing. If you look at Nielsen numbers, each brand, and I'm talking about even the biggest brands which are there in the GT space, they will typically be losing 8 to 12% of sales just because they're out of stock in certain points or the other at certain points of time. So for the retailers to have that flexibility to be able to order, a top-up purchase without waiting for the distributor salesman to come when he comes, once a week and so on. I think that's a big use case. I think the other big use case is all the non-core SKUs. Now, Hindustan Lever itself has about 50 brands. And, and every day there are new SKUs, new variants which are being launched. A physical distribution system, which is 70, 80 years old, is not able to keep pace with the level of innovation and the level of complexity that is required by consumers of today. And that's what they demand with their retailers. I think using technology, using platforms like us, allows us to, in a very democratic, very transparent manner, give the same kind of focus to their tail SKUs as they give to their head SKUs. Not to mention the scaled up supply chain that we have, which is how we are able to fulfill the demand of these long tail of SKUs versus these small distributors which are there in each city, and they are not able to cater that particular use case. The third bit is about, again, access to new channels. So, Hindustan Lever is great. I mean, I worked for a long time there. So I know how, Kirana is absolutely the go-to channel. They're building capability on beauty channel as well, because there is a plethora of beauty brands and there is a lot of focus on that category. But still there are other channels, pharmacy channel. Even a company like Hindustan Lever doesn't really have the scale and the offerings to be able to serve a pharmacy kind of a channel in a meaningful manner. Because we are multi-brands, we are able to take the entire bouquet of offering across these categories, multiple brands. We can be a meaningful partner for them to access some of these underserved channels like pharmacy. So these are just some of the use cases which are developing, and I can tell you that all the big companies are partnering with us already, and in a very proactive and an engaged manner, because they see the benefits accruing to them today and tomorrow.
The next question is on private label. Can private label make for a meaningful share in the longer term, and do established brands perceive Nykaa as a threat at some point? Should they?
I think this question can be answered both for fashion and also for beauty. So I'll request Adwaita to first answer it for fashion, and then we'll come back to beauty.
Yes, absolutely. Sorry, can you just repeat the essence of the question? I was actually just getting up for a quick break.
Why don't I go first? The question is around basically if private brands are viewed as a threat by other brands. Is that correct, Brinda?
Yes. I'll just repeat it again. On private label strategy, can it be a more meaningful share in the longer term? Do the established brands perceive Nykaa as a threat, or will they perceive Nykaa as a threat at some point?
Okay. So yeah, maybe I'll kick it off for beauty first. And I think I kind of had answered this question earlier as well, but just to reiterate, for us, it's a consumer backward proposition, and our private brands are, they've been innovative, and they've come up with their own set of products and SKUs that they think are relevant to the Indian consumer based on their understanding of the market. Internally at Nykaa, we tend to function. The two businesses, the private brands business and the multi-brand retailer business, tend to function very separately and distinctly. In many ways, there is a Chinese wall that exists between the two businesses. There's a separate chief executive, separate teams, pretty much for every function. And so there is no sharing of information or anything like that between the two. And I think our brand partners have seen how ethically we have behaved in terms of running these private brands totally independently, that they have chosen to continue to work with us, 10 years down the line. And, our private brands have now been around for the last 6 years at least. So we don't see it really as a challenge, as long as we're delivering to our brand partners, which we clearly are doing. And there is no gray area in the way we function, and we do it with integrity and respect for all of our partners. I think anecdotally, what I can tell you is, I look after the multi-brand beauty business, and I work with my counterparts at HUL, L'Oreal, Estee Lauder, and at Nykaa's own private brands department in the same way, and with the same frequency of interaction and collaboration. And the same goes for my teams as well. So I think our partners have seen that, and they've appreciated that. And unlike some other vertically specialized competitors within the beauty space, as well as some other horizontal marketplaces for beauty, where they have been a lot more aggressive about their private brand strategy, right? So I think Nykaa, as I mentioned earlier, no single partner of ours accounts for double-digit revenue contribution. And so it's a very fair, even playing platform. And others are pushing their private brands in a much more open, aggressive way. And finally, the reality is that in the beauty space globally, whether it's the big, whether it's Sephora or Ulta or even others in other markets, all beauty retailers have always had their own private brands. So I think it's also just part of the, it's just, how business is done in this industry. And as long as we are delivering to our brand partners and doing things the right way, I don't think it should cause a concern. So I hope that answered the question.
Perfect. On the fashion side, I'd echo, a lot of similar sentiment. I think we take the role of being a multi-brand retailer very seriously, and the brands that are being built are really treated, just as a completely different vertical, completely different business, where they're truly trying to build brands that stand on their own feet. And, again, I think in fashion, it's even less of a problem just because there's so much more brand proliferation. There's much less brand concentration of, what's selling. So I think there's space for own brands to be launched and find a spot for themselves on the platform.
Thank you. Next question. Can you please provide some perspective on Nykaa Man?
Yeah, I'll come in on that. So I think Nykaa Man is a platform that is a combination of personal care products, like what we call as grooming products, and we believe that men buy a little more horizontally, and hence we added some of the fashion offerings to that. I would say the reason why there has not been that much emphasis on Nykaa Man is because from a technology and cataloging perspective, we are behind where we would like to be, and there is more work needed to grow those in those areas. And I think from a prioritization perspective, organizational prioritizations perspective, there's been more focus on completing the fashion offering as well as the B2B launch, which was done 7-8 months ago. And I think as in when we put greater emphasis on Nykaa Man from perspective of pushing the handle, we would definitely talk about it more. At the moment, there's not much to share, and all the financial implications of those are either captured in beauty or fashion, because it's difficult to try to explain numbers in so many buckets, as well as as a new platform, what amount of GMV and the investment is also being shared in our segmental reporting. Not segmental reporting, but where we've given, the segment specific revenue and EBITDA.
It's part of others vertical.
Yeah, it's part of others vertical. Thank you.
The next question is about our partnerships. Can you please talk about the salon service offering with Estee Lauder? Will Nykaa make the right investments in the future as well? And can you please throw some light here?
Yeah, so maybe I'll start and others can feel free to add. But, for us, the Aveda partnership for salons was, I think, a testament to the kind of deep relationships that we've built with these brand partners at the global level. Just to give you some background on that particular relationship, I mean, we started, we were Estee Lauder's first e-commerce partner in India. They launched online for the first time in India with us. And that was with just 4 brands, Clinique, Estee Lauder, Bobbi Brown, and then MAC came shortly after. Today, over 9 to 10 of their brands are currently being sold on our platform as well as in our stores. So that relationship has truly expanded. And, anecdotally, we spend a lot of time with them, not only in India, but at their global management level. I myself and also Falguni spends a lot of time with them and other partners as well, whether it's L'Oreal or it's Hindustan Levers. We tend to spend a lot of time with our partners. And we always say we're in a client servicing business. So I think this salon launch is just the latest in a long line of interesting, innovative initiatives that we have done in conjunction with our brand partners. And again, it's the first time we're doing this. We've never done salon services before, but I think Estee Lauder saw the way in which we've rolled out our physical stores, and they've now decided to partner. I mean, they've partnered with us pretty much in all of our formats, Luxe and On Trend, for different sets of brands. But I think they saw the excellence of execution in the way we roll out our physical retail stores. In a matter of just a couple of years, we went from being an online-only retailer to truly being an omni-channel retailer and having 100+ physical stores. And I think they saw that excellence in execution and operations and projects and the art of retailing, that they decided to really partner with us to even try this new initiative of salons. Aveda salons are, as I mentioned, there's 9,000 of them globally. So it's a very dominant salon franchise. So we are very excited to start this business in India as well. And sorry, what was the investment? It's it's a partnership, so I can't disclose the details of the investment. But I mean, both parties are contributing to the partnership.
The next question is on BPC. How was the inventory trended in the beauty and personal care business?
Yeah,
Arvind, will you
sure
take
what-
that? Sure.
Yeah.
I think Arvind take that.
Arvind, why don't you start? It's a kind of an open-ended question, but yeah, if you start, I can also add.
Yeah, so I think our working capital schedule that we presented during earnings call does indicate that we have increased our inventory levels quite meaningfully, and there are two drivers behind it. First, we wanted to secure inventories in an environment where supply chain disruptions are quite hard to predict. And second, because we were regionalizing our supply chain, the overall inventory level does go up because we wanted to make sure that every geographically centered center has enough of inventory to match the order to nearest supply center. So due to these two factors, inventory levels have gone up. But like we have explained in past that we keep a tight eye on inventory levels. We operate in a category which has higher shelf life. We have RTB arrangements with our suppliers to be able to return in case something doesn't sell up. And we have very low inventory losses. I think the working capital bit of investment that went in FY22, part of it will unwind next year as we will be able to turn around inventories faster and supply from the nearest fulfillment center. So Anchit, would you like to add something to this?
No, I think you covered it. I think the only additional thing I would add is that there was a lot of uncertainty last year in FY22 around what was going to happen with supply chains globally. A lot of our brand partners were telling us that the demand had obviously jumped back globally before the supply had. And so we wanted to be aggressive. We wanted to make sure we did not have any out of stock loss, both financially and obviously support consumer experience. So yes, we were aggressive to ensure that we were able to pick up stocks because we didn't know what was going to happen next with the pandemic and with supply. So we did do that investment. But as Arvind said, we're relatively well protected because these are long shelf life products. We've got strong return to vendor clauses. But we don't even, you've seen in our numbers historically, we've had less than, I think, Arvind, you can, if it's something we've disclosed, you can talk about, what percentage of our inventory is written off in any given quarter, but it's very minimum. And it goes to show you that we manage our inventory very, very well and are able to ensure that it's liquidated in the worst case prior to expiry.
So the next question is on fashion. At what GMV scale can we expect marketing spends to normalize to BPC levels? What will be the driver to achieve that GMV volumes, AOV, or both?
Can I just come in and then maybe Adwaita can add? I personally feel that for any business to get to it all depends on, of course, on the AOV, and there are many things that play in, but I think it needs a good mix of repeat customers versus new customer to be able to be at a healthy marketing as percentage of total. And I think for fashion, it'll take maybe over the next year or so, we will work in that direction and try to keep improving our marketing spend from current levels. I think just also wanted to mention again that fashion is a business where we only report take rates as a revenue, and hence the marketing costs at NSV level are, of course, more comparable than marketing costs at net revenue level. And I would want everyone to look at our marketing costs in fashion at the NSV levels. And on the NSV level, these costs would come down over time. So Adwaita, do you want to add to that?
No, I was going to say exactly that I think, at least from our beauty journey, what we found is that the minute the repeat behavior starts kicking in a meaningful way, the minute you start accumulating, a very meaningfully sized database of customers, you end up seeing a pretty dramatic decrease in how much you're having to spend. So I definitely think time and is going to be a big player in just bringing this down. So what you can hear from us is that every day, every month, we attempt and will aim to bring this number down. And that is our focus. A lot of the positivity just comes from that repeat behavior kicking in.
The next question is also on
And
fashion.
sorry, I also wanted to point out that our marketing cost number includes our content costs also, which are going to continue to, Nykaa is going to continue to invest in content costs. It's albeit small, but again, with live commerce, so there are areas of investment that may come in. And over time, there could be more branding costs, not just as a retailer platform, but also for many brands that they're seeding. So at the corporate level, the expenses on marketing need to be looked at in totality. What we try to optimize is more the performance marketing or digital marketing.
The next question is on fashion. Do you have exclusivity with the international fashion brands that you have launched on your platform? If yes, for how long?
So, it's a mix. With some brands, they're only listing on our site, and with others, they're listing kind of, in a couple of different places. I think I wouldn't say that there's a blanket exclusivity across the whole international strategy. It's sort of case by case basis, negotiated for a couple of months or slightly longer period than that. But I do find that these brands are typically keen to not sort of lock themselves up into long exclusivities.
I think there is one more question on fashion physical stores that I would like to proactively answer.
Yeah.
I think if people are wondering whether a private label in fashion, are they going to be only private label stores in fashion or larger format store? I just wanted to say that we don't, even like in beauty, only few of our brands in our store, which are meaningful value creators for those brands and hence meaningful income and revenues for our business. So I think similarly in fashion, there is no plan to have large department stores that stock all the brands and many brands where we may not be adding much to the distribution footprint. But I think it will be a combination of private labels for sure and some additional brands where our physical distribution may help grow those brands in the country. Would you agree, Advaita?
Yeah, exactly. And I did mention that when we were on that slide that we are, experimenting with 2 or 3 different formats with different mixes. But yes, it's broadly across own brand / private labels, import / global brands that we're bringing internationally, and then some very sort of interesting brands within India. And all of that together should create a bit of a differentiated mix such that people want to come to these stores. It's not something that they can commonly find elsewhere in the mall.
Thank you. The next question is on BPC. For offline stores plans going forward, what do you anticipate? Will there be more on-trend stores or more luxe stores?
So look, I think the reality is that there is a limited number of luxury catchments in India, and by catchments I mean malls and high streets and pin codes and clusters where there is that level of affordability and affluence. So I think that is slightly capped beyond a point. So, but that's where on-trend comes in. On-trend is a great format to really introduce consumers to that bridge to luxury, to masstige brands, and to get their first taste of premium brands that are slightly better priced. So I think longer term on-trend can be a larger share of our retail footprint than luxury. Today, I would say it's probably 50-50, and we'll continue to open in a similar ratio over the next couple of years. But yes, maybe 5 to 10 years down the line, I think there'll be a lot more opportunity for us to penetrate very deep into the country. Already, we have consumer data that tells us that we can probably have at least a store or 2 in the top 100 cities in this country. Beyond that, I think you'll see a lot more on trend, or maybe even newer formats beyond the top 100 cities after the next couple of years.
We'll take the last question now. Could you share how use of technology and data analytics has helped in each of the verticals? If you can share them with 1 to 2 examples, that would be very helpful.
I think, Brinda, your last question will probably need an hour of answer. So my suggestion would be that maybe even the next time, I think we were a little bit worried about what kind of attention we can hold over a 3-hour session. But I think what we can do is that the next time when we are doing a deep dive like this, we can definitely bring in our technology technology team to come and share the experiences on what all we are doing, because I don't think this is a question that can be answered over such a quick, over a few minutes. So I think, unfortunately, I don't think we'll be able to answer that in this session. There are also a lot of deep dive questions on ad revenues, and while we have said that we are seeing healthy ad revenues, but I think the potential for that remains quite large. I think the globally world is talking about how e-commerce players, with their ability to have a very quick conversion from advertisement to sale, are a good place for brands to advertise. And but obviously the companies need to do a lot of work on personalization and how they take the consumer down the journey of personalization and influence. So I think, again, that's a very large subject. So I think you all have given us a lot of food for thought in other areas of information about the company that we can share over a next session like this that we may do over next 5 to 6 months. So thank you for that. I think, unfortunately, we are at about 7:03 now. And I think a lot of you have been very patient and heard us out for long. I can also see the participation dropping now. So I think that's a clear cue to us that I think we need another session with all of you. But thank you for being there for us. And we really appreciate that this ability to be able to explain our business model to all of you.
Thank you very much.
Thank you.
And we'll note all the questions and bring them back next time when we talk to you.
Absolutely. I think we'll conclude the session for the day. Thank you so much, all of you who have taken the time out to attend today. We hope you enjoyed listening to our speakers and gathered a little more insight into the vision and business of Nykaa. Have a very good evening, and we'll come back. Thank you.
Thank you. Bye-bye.
Thank you.